A retest of 5% for the benchmark 10-year Treasury. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And with about 2 hours to go, we're actually looking at a little bit of a rally, at least when it comes to the S&P 500, currently up about 0.4%. Bit more so if you take a look at big tech, the NASDAQ 100 up about 0.9%. A lot of that ties back potentially to what we're seeing in the bond market, that 10-year Treasury yield. We actually got to 5% overnight. Now you can see yields coming down a bit, retreating a bit, currently about 7 basis points lower. And I don't do this often, but we have Bitcoin up on the board because Bitcoin really rallying, currently up about almost 4%. Of course, it rallied over the weekend, and right now it's right at about $31,000 for the first time in several months, Romaine. Yeah, it's definitely something we're going to talk about today. A lot of big stories, but we do start off, of course, what we saw in the Treasury space. That Treasury sell-off is indeed abating this Monday afternoon, Katie, though we should point out that the broader positioning remains the same, and you saw that with the spike earlier in the day. CFTC data showing large speculators staying short U.S. government bonds, with hedge funds adding to some of those bearish bets in 2- and 5-year futures, so the short end of the curve. Dealing desk telling Bloomberg that the commodity trading advisors, they're still holding significant shorts as well. And while asset managers remain net long, they have started to trim those bullish positions. But billionaire Bill Ackman said he's seen enough, posting on social media that he covered his short bet on Treasury, saying that there's just way too much risk in the world to remain short bonds at current long-term rates. Of course, the other big story this day, and really, frankly, for this week, are going to be earnings, kicking into high gear with more than 160 S&P 500 companies reporting this week. The ability for that index to pull out of its profit contraction is going to be heavily dependent on the tech heavyweights. Meta, Amazon, Alphabet, among some of those names that report this week. To put a point on the market's resilience on those names, consider that technology, the S&P is seen posting an EPS drop, of more than 2% for Q3. And if you exclude just the 5 heaviest weighted members of the index, that profit drop extends to more than 5%. And investors have been somewhat unforgiving already for any company that missed profit expectations. Bloomberg Intelligence, Katie, finding that for those names that lagged analyst expectations, their stock underperformed the benchmark by a median of about 3.7% on the day of the results. Unforgiving, punishing, really pick whatever your word you want to describe. But you can say basically that the reaction when you miss your earnings, it's been particularly bad so far this earnings season. Like Romaine mentioned, 3.7% lower the day after reporting, if you report a profit miss. That is the worst going back several years. Our data actually goes back to 2019, and we've never seen a season that bad in the span of those 4 years or so. So we'll see, really, as we get into the meat of earnings season, if that continues. Of course, though, if you take a look at the broader benchmark level, the S&P 500, and you take a look at Citi's revisions, they've been coming down as we head into, again, the real thick of earnings seasons with the big tech companies reporting. So the bar has been lower. There's a lot of pessimism, and it's been punishing out there, Romaine. Absolutely. Let's kick things off here with Kristina Hooper, Invesco Chief Global Market Strategist, to help us kick off to the close. And Kristina, as earnings season really starts to get into, I guess, the heart of it, there has been a lot of discussion about whether the Q3 numbers are going to be that sort of trough, if you will, in that sort of profit contraction, and whether we see something a little bit brighter for Q4 and beyond.
Well, Romaine, we could very well, but I think it's going to be a sector-specific story. For example, technology. One of the reasons there's optimism around that space is because there have been significant cost-cutting measures implemented by a lot of tech companies. So that puts that sector in a different place in terms of earnings than others. So I think it will be a sector-by-sector story. But we could certainly see improvement. A lot of this will depend upon the lagged effects of monetary policy, quite frankly. If we do get a soft landing or even a bumpy landing, it's going to be a different picture than if we get a hard landing.
It's interesting about those lagged effects. I mean, the Fed, to a certain degree, has acknowledged this without maybe saying it explicitly. They've also acknowledged the fact, Kristina, that I think a lot of market watchers already know, which is that a lot of the moves that we've seen in the Treasury space over the last few weeks and months have actually, to a certain extent, ended up being, I guess, an effective rate hike in and of itself.
Absolutely. And that is really the silver lining in what is an ugly picture right now, which is that this increase, this very significant increase in the 10-year yield, for example, that tightening of financial conditions hastens the end of the rate hike cycle, in my opinion. So we're going to rip the Band-Aid off, and we're going to get closer to looking ahead to an economic recovery.
And with that economic recovery potentially that we're heading to, with that in mind, I mean, do you go and buy risk right now? Is that the playbook if really we do see financial conditions tightening, bringing an end to this hiking cycle?
Well, I think what you do is look for opportunities right now. We have a window of a few months in which I think there's going to continue to be a lot of policy uncertainty. And so we could see very significant swings in the 10-year yield during that time, and we could see additional pressure exerted on stocks. But we have to recognize this is likely to be a very short-term phenomenon, so we should be sharpening our pencils, getting ready to get in, and in some cases, dollar cost averaging in.
And when you talk about the pressure that those rising yields put on stocks, where exactly in the stock market are we talking about? Because the narrative over the past several years has been, you think about big tech with those long duration cash flows. That's where you should see those rising yields start to pinch, but it feels like it hasn't necessarily gone according to that plan.
Well, that's been the rule of thumb, but keep in mind we've had this very powerful theme that has been driving the tech sector over the last almost a year now, which is the excitement over artificial intelligence and all that it can deliver and all the different beneficiaries within the tech sector. So that certainly has altered the picture, but it tends to be a good rule of thumb to assume that the long duration equities are the ones that are weighed down the most by rising rates.
When we get to this idea, though, as to rates staying where they are, or at least somewhere in that range, assuming that the Fed doesn't actually have a reason to cut materially here, Kristina, how much does that change the valuations that we're seeing in the market right now, given the sell-off? And it's been a pretty pronounced sell-off, at least since, I don't know, basically since the end of June, mid-July.
Well, what I think is happening is that we're seeing a repricing of the slowdown to come. Last year, we saw about a 25% sell-off in the S&P 500, and that really was foreshadowing what was anticipated to be a modest recession. What we've seen since then, of course, is a retracing. We saw a nice move up for stocks, and then, of course, a pullback that suggests, if it ends soon, that we're going to get a bumpy landing as opposed to any kind of significant recession. So I look at this picture with that in mind and think that rising yields and the pressure they're exerting on stocks is just part and parcel of that forecasting of what's to come.
Kristina, always great to talk to you. Kristina Hooper there over at Invesco, helping us kick things off to the close on this Monday afternoon. Coming up after the break, a closer look at the IPO landscape, which of course caught a little bit of heat over the last few weeks. Jason Paltrowitz over at the OTC Markets Group will be stopping by for a conversation on that.
Plus, it's the second oil mega deal this month. We'll discuss Chevron's deal to buy Hess.
And a closer look here at airlines, part of our interview with the CEOs of Delta and Virgin Atlantic. All that and more coming up in just a bit. This is The Close on Bloomberg. All right, the latter half of the year so far has been a particularly busy period for mergers and acquisitions. More than $139 billion in takeovers of publicly traded U.S. companies have been announced this month alone, marking the highest volume for any month going back to June of 2019. Here to talk a little bit more about what's happening in the M&A market as well as IPOs as well, Jason Paltrowitz, OTC Markets Group Director, joining us right now. And let's start off here, Jason, with the M&A side of this. Of course, that also functions as, I guess, to some degree, some sort of a palatable exit plan for some of these companies. But when you look at the types of M&A activity we've gotten and how it's functioned in terms of how they've been funded, I should say, what's different this time versus what we saw in past cycles?
Well, Romaine, thanks for having me again. I think what's different in this cycle, at least from our perspective, what we're seeing is a lot more smaller caps participating amongst themselves. I think in 2021, 2022, we saw a lot of these companies enter the market looking to access U.S. investors. I think kind of the interest in those companies has waned a little bit. And so we're starting to see these companies combined together to be going concerns as they go forward.
Now, we start off on that side of it, but you flip to the IPO side, Jason. I'm sure you've seen some of the big names come to market, the Birkenstocks and ARMs and Klaviyo's of the world here. And overall, they've done okay. They certainly did well at the IPO, not necessarily in the secondary market. I don't see a lot of smaller names, though. Birkenstock is a name. ARM is a name. Even Klaviyo, you can say, is a spinoff or a splintering off of a name here. For those companies that don't have that pedigree, how are they going to fare if and when they do choose to come to market?
Well, it's interesting. You know, these big names get a lot of the press, but what you don't see is the number of small cap names that are actually coming to market. This year alone, in fact, there's been over 130 IPOs. Over 60% of them are deals that are kind of done at less than $10. In 2022, we saw close to 100 IPOs in small and nano cap companies, sub 300 million. Those companies really aren't faring well. There's this rush to raise amounts. In fact, this week, there's 3 IPOs that are sub $10 million in raises. A lot of this is really driven by the bankers. But what you're seeing is that they really are underperforming. If you look at the 2023 cohort, again, 130 companies, 60% of which were sub $10 on the raise. Almost all of them are in the negative 50, 60, 70%. And so a lot of the pressure is on the big names, but you're really seeing a lot of small company names coming to market and not doing very well.
And when it comes to some of those small and those tiny cap names, I mean, there's a lot of successful private companies. If you're running one of those smaller companies, you're seeing the track record of your peer group coming to market and not doing well. What are some of your considerations for when and if you should go public?
Well, certainly when we look at it, there's a long glide path to being a U.S. exchange listed company. Being on the markets that we operate, our OTCQX and QB market, give companies the ability to be public, but again, learn to grow into being public. I think if you're a CEO and you're looking at your cap table, you're looking at your fiduciary responsibility, you're looking at what it would take to take on the costly burden of being on a U.S. exchange, I really think you need to consider whether or not it's worth the effort. Again, you have a fiduciary responsibility to your shareholders. So doing things like reverse splits in order to meet the listing requirements, offering banker warrants, dilutive financings, all of those things are really bad for the ecosystem generally, and are the things that we're seeing more and more of in these markets. Again, if you look at the 2022 cohort, a lot of it was, over 51% were the same 5 bankers, but over 50% had banker warrants. The negative return on those deals is over 60%. So I think CEOs really need to make sure they can support the public markets before they take that leap onto an exchange.
And Jason, broadly speaking, we're starting to see a little bit of life come back into the IPO market. Can we talk a little bit about SPACs? Are we ever going to see the same breathlessness around SPACs that we saw maybe 2 years ago? Or was that really just bull market behavior?
I think from our perspective, that was really bull market behavior. I think, as we look at it, it's almost as if it was the fashion of the day. We're not really seeing a lot of interest, certainly not a lot of activity from our perspective.
All right, Jason, really appreciate your time. Great to chat with you. That is Jason Paltrowitz of OTC Markets Group. And Romaine, you heard it here first. Maybe we see the IPO market start to see a little bit more activity here, but SPACs, I don't know if that follows necessarily.
What about Sparks? How is that doing?
I don't know. It's a good question.
It gets to the idea, though, too. And I mean, he points out the idea that was certainly a bull market phenomenon. And that was kind of easy money, right? I mean, if you were looking to come to market, not only easy money, but easy from a regulatory perspective. And maybe that ship has passed. I'm sure they'll, somewhere in the future, our kids, when they're on this set one day doing this show, which is my hope here to pass this on to my children, is that they will have then their own sort of phenomenon, bubble phenomenon to talk about.
Who knows what acronym they'll have. I look forward to watching and finding out, but we'll have to wait for that. But coming up on The Close, Chevron's mega deal to buy Hess. We're going to listen to part of our interview with the CEOs of both companies next. This is The Close on Bloomberg.
The second oil mega deal this month, and it's a big one. Chevron said it's going to buy Hess for $53 billion. Bloomberg's Alex Steele and Guy Johnson had a chance to sit down with the CEOs of both companies. Let's take a listen.
Our stock for the last 5 years was the #1 total shareholder return in the industry, whether it's independent or whether it's major oil company. Last year, our stock went up 94%, #2 on the S&P. So we've already created a lot of value. At the same time, now that the pricing got in a range that would work both for Chevron and work for Hess, we think we came up with a win-win. Hess brings Chevron growth in resource, growth in production, growth in cash flow. Chevron brings Hess financial strength in terms of a diversity of world-class assets, in terms of sterling balance sheet, and in terms of industry-leading cash returns. And when you put the two together, you create the premier oil and gas company positioned for the energy transition.
Mike, what I'm hearing here is that this is a great fit. Could you do this on your own? Could you build what Hess has built from the ground up? Is it easier to buy than build right now?
Well, look, this is about long-term growth and long-term value, which is what we're always seeking. Hess has a unique portfolio that actually strengthens our portfolio with some things we're always trying to do. We're always out exploring. We're looking for new finds. Guyana's the biggest discovery in more than a decade in this industry. It's just a unique and compelling asset. And so it would be difficult for us to do on our own. We continue to explore. We'll continue. Everybody in our industry is looking for these things. But this was a great opportunity for us to join a partnership that's done a terrific job in developing this asset. But also the other assets in the Hess portfolio are ones that will be additive for us as well, the Bakken, the Deepwater Gulf of Mexico, Southeast Asia. And so it's a very nice fit at a portfolio level, nice fit at a culture level, and we're going to create more value for shareholders.
Isn't the message coming from this that the industry is now at a point where it is going to invest in the future, that the energy transition story is of interest, but it's not the only area of interest, that this is an industry that the country, that the world still needs to rely on? You could have done other deals. You did this one. Isn't that the message that comes from this?
Well, I'd put it a little differently, Guy. We have done other deals.
Yep.
Earlier this quarter, we closed on the largest green hydrogen manufacturing and storage facility that will be built in the United States. We're the second largest renewable fuels producer in the U.S., and we're expanding our production capacity there. So we are doing the other deals. But I think the point that John's making is really important. We need to continue to invest in the energy system that supplies the world today, even as we're investing in one that can integrate into that and help reduce the carbon intensity tomorrow. We believe the future of energy is lower carbon. We believe these new technologies will play a greater role, and we continue to invest. So I don't think you should read this as a lack of commitment to the energy transition, but we need to invest in what the world runs on today. This makes us a stronger producer. It takes two great American companies and brings them together, which is good for national security and economic security. And we're committed, both of our companies are committed to a lower carbon energy system.
Mike Wirth there alongside John Hess, speaking with our very own Alex Steele and Guy Johnson. Pleased to say Alex Steele joins us right now to talk a little bit more about this mega deal. And it is indeed mega. We talk about the price tag here, but also let's talk about really what Chevron gets out of this. I'm told that there's a new player in the oil space off the coast of Brazil somewhere, and that this deal has a lot to do with that.
Yep, so it was 2015 where Guyana, which is off the coast of Brazil near Venezuela, and it's the first real exploratory field that has come to fruition in the last decade. And it's going to be really hard for these big oil CEOs to go and really do greenfield. So greenfield's like there's nothing there and you go find the stuff and then build the project. That takes decades, that takes bazillions of dollars. And to do that when you don't know where the energy demand is going to be in 2050 would be very difficult. So buying it versus developing it would be very different scenario for these guys. And that's part of what they get. They also get the Bakken. The Bakken's not nothing. They also have a lot of technology and tools that they can use in the Bakken to get more oil out there. That's North Dakota. That's not the Permian, but it's still something.
So Chevron buying Hess would be news in and of itself, but it's especially interesting at this moment because it's just a few weeks after Exxon bought Pioneer. Who's next? Who else should we be watching for when it comes to consolidation in this industry?
I mean, you look at Conoco, right? Like they have the Alaska play, they have shale, they have stuff. They're still integrated in terms of having stuff overseas. Also, I should say not integrated, but having stuff overseas. But I don't know that they'd make this kind of big acquisition. I think everyone's waiting for the little guys in the Permian to team up. And by little, I don't mean little. I just don't mean mega deals. But so if you're two mid-tier players, like, you have to combine now.
Yeah.
Like, how can you possibly compete against the wallet that is Chevron and the resource that is Exxon?
Well, that's what I'm curious about. I mean, it's kind of the wildcatter days. Is that basically over, at least here in the U.S.?
No, because they are, what, 400 small players in the oil patch.
Yeah.
And it's those guys that can do a lot of the technological advances and try different things to get more oil out of the ground that you're going to actually need, because there's just not as much rock. Like, there's just not infinite rock, right? So you have to get as much as you possibly can out of the good rock, and that's what wildcatters do. They do that cool, fun, edgy stuff.
Yeah.
The big guys are going to have a harder time really trying out new technologies.
Katie was just asking in our chat what a wildcatter is. That is actually the mascot of the Northwestern University.
Okay. Wait, went to Northwestern?
No,
she did not. No,
I did. Wait, did we know this?
Yeah, we did know.
We did know this,
Alex. Just don't say what year I graduated, please, on air. I am curious. I am curious. In all seriousness, when we talk about the size of these companies now, there are no regulatory issues, antitrust issues that we need to worry about.
It's going to be really hard because for Chevron, they're not already really in the Bakken, so that's one part. Also with Pioneer and Exxon, there are already so many other players still there. And why would the U.S. care about Guyana? Also, it's going to be really hard if you're a government to come out and be like, we don't want you to merge, when, like, they're talking about energy security and wanting more oil. Also, remember that Chevron also has a Venezuelan asset, too, and they're able to produce more now because of sanction relief. So you kind of need everything to work in harmony at this point.
I'm still Googling what a wildcatter is, but we need to talk.
Cowboy boots, cowboy hat, doing cool things with oil. That's literally what it is.
That sounds like a Beyonce concert.
We only have about a minute left, but talk to us about the trucks. Are we still going to get Hess trucks this Christmas?
Yes, the Hess trucks. Please tell me that you have not bought your son the iconic Hess trucks.
There's one floating around in a storage box somewhere.
Yes. That was actually my first question to John Hess. Apparently, it was a point in a negotiation. They did talk about this, and the trucks will happen. They will continue. They will be with you for Christmas. Do not fear. You could sell like 1 million every Christmas or something crazy.
Okay. Well, I'm glad I don't have anything to fear. I mean, I hadn't made my Christmas list yet.
Yeah, but Guy Johnson doesn't even know about it. So apparently it's like a U.S. truck.
Well, we're talking to him about 20 minutes. So.
Yeah, but I mean, you got to get, what do they have on the lorries? Is that what they call them over there?
They call them lorries.
I don't know. We'll see.
Hess truck.
Yeah, Guy's kind of weird. Maybe we'll try to catch up with him a little bit later. Alex Steele, of course, who co-hosts Bloomberg Markets, the European Close, alongside Guy Johnson. A great interview earlier today with John Hess and Mike Wirth. Stick with us here on The Close on Bloomberg. This is the countdown to the close, almost 2:30 here in New York. Let's get you caught up on what's happening in the commodity space. Abigail Doolittle is standing by right now with our commodities close. Abigail.
Well, taking a look at this board, Romaine, not surprisingly, overall, we do have the Bloomberg Commodity Index down. It's interesting, though, most commodities on the day are actually down just slightly or even slightly higher. But because of the weighting of the energy complex to the commodity index, that is why we have that weakness. New York crude down 3%, nearly 3% down for a second day in a row. Today's slide is the worst day in nearly 3 weeks. So the big rally that we had higher, it is reversing a little bit. Last week, I was talking about how the chart technicals are suggesting that we could see a big move to the upside or the downside. On today's action, it does look more likely to be the downside. We'll be showing that chart soon. Stay tuned. Silver, though, is also lower. It's not just gasoline and heating and oil. It's also silver, down 1.2%. Some of the rally that we saw over the last couple of weeks for the precious metals, that is coming off as well. One commodity that is higher on the day, though, that is cocoa. And this, of course, is as cocoa is soaring to a 44-year high. So this chart goes all the way back to 1975, a big rally, more than 400% up to that peak, and then down about 88%, and now down up another 450% from that low to today. And Romaine, I don't know if you're a big chocolate eater or not, but this chart does look like it can continue to go higher. This area of congestion is breaking out to the upside. Again, the highest level for cocoa in 44 years.
Yeah, I like chocolate, just not the dark kind. I need like 60% milk fat in there somewhere to make it palatable.
Not white chocolate.
All right, let's dive into what's been going on in the Treasury space, because a lot of volatility there. The 10-year Treasury yield at one point did breach that 5% level for the first time since 2007 before, as you can see there, dropping back down pretty significantly. Bloomberg's Liz Capel McCormick joining us right now to talk a little bit more about the wild swings that we're seeing here in the year of the bond. I don't know if it's really the year of the bond, and maybe the year of the bond volatility.
Exactly. If this is the year of the bond, you don't want it, you know? And I kept saying, the year of the bond, time is running out because people were saying we're still going to do okay. What is it, October? But yeah, crazy chart today. Yields went way up, broke the 5%, and like Katie was joking, it seems like Bill Ackman saying he got out of his short, bang, and then we're down. I don't know, maybe I'm a little, you know, battle weary, but I'm hard pressed to say for sure it's over. And you know, we talked to some other fund managers who are saying 6%, why not? You know, so we'll see.
Well, who knows if it's over? But like you said, it's a crazy chart, and it was cool to see basically yields kiss 5% and then come in. So Bill Ackman obviously closing out his short. Was 5% probably a level for some of these other big guys too, saying maybe now's the time to take some profit?
Well, I think all along the way, some of the longs, I mean, the shorts have been kind of slowly getting out. I do think the CTAs are still heavily short. But like I said, I mean, joking aside, there are some that said, like, listen, nobody thought we'd go to 4.5. We went to above 5. I think Ira Jersey, our resident expert, was saying earlier this morning that really the technical level is like 5.3. So 5% is just psychological. So I think you're slowly having some shorts cover, but there's still a heavy short position on the future side, especially.
Well, I'm curious too about the positioning. I mean, we know that the hedge funds have been short for some time. You mentioned the CTAs, but even the asset managers, while I know they're technically long, they've been trimming those bets to a certain degree. And then when you talk about that 5% threshold, I was trying to look it up. I can't remember who said it, but there was an interesting strategist last week or the week before who kind of said that 5% was going to be that line in the sand that would attract a lot of buyers, and maybe that's why we saw the bounce.
Yeah, that makes sense. I mean, and you look at the long-term macro hedge funds kind of folks and the multi-strat kind of things, they're saying we're looking to make returns over the next 2, 3, 5 years. So capturing bond yields with about a 5% coupon, even if we take some pain in a little while, that's okay. You know, even my kids who are in their 20s, I'm like, usually I'm saying buy all stocks, but I'm like, you know, maybe you want to buy some bond funds now. That may come back to haunt me, but, you know, because those yields are good. And what if, you know, we do have a recession and we don't see those again? So,
yeah, we'll certainly see. Liz, it's great to catch up with you. Our thanks to Bloomberg's Liz McCormick.
You know what I found over the weekend?
Tell me.
A treasury.
No.
A paper treasury from it was like from the late 50s or something. It's $100.
You gotta frame that. You gotta frame that. Yeah, keep it close. Still ahead on the close. Costly jet fuel prices and the war in Israel are leaving U.S. airlines to adjust spending and operations. We'll speak to Helane Becker of TD Cowen about the trends that she's seeing. This is The Close on Bloomberg.
Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with Salesforce, cut to neutral. This over at Piper Sandler, along with about 15 other software and cloud computing companies. Analyst Brent Bracelin says that while sector valuations are bottoming, so too is growth. And he's less confident in the ability for those companies to materially re-accelerate the pace of new business. Salesforce shares down fractionally on the day. Next up, Pinterest, Stifel, going to buy from hold on the company. The price target set at 32, with the analyst saying the digital advertising checks have been largely positive and teases that there's lots of room for growth outside of the company's domestic market. Pinterest having a decent day, up 3%. And finally, Spirit Aerosystems cleared for takeoff over at Berenstein with an upgrade to outperform, with the analyst saying Boeing's cash infusion gives the airplane parts supplier enough money to cover that 2025 debt maturity that investors have been obsessing over. The firm also citing a change in leadership that should bring more operational expertise. The price target nudged higher to 50 to 29 from 25. The shares higher by 6% on the day. And those are some of our top calls, Kitty.
Well, sticking with airlines, the CEOs of Delta Airlines and Virgin Atlantic shared their thoughts about the state of the U.S. economy when they spoke exclusively earlier on Bloomberg Television.
This has been the most forecasted recession I've been in business over 40 years that I think I've ever seen. And as far as I'm concerned, I think we're going to have a good landing.
We're just seeing the recovery of the international markets. There is a softer landing or a good landing, as Ed said, for the U.S. economy. Europe has got to be probably a year behind that.
Joining us now for more is Guy Johnson, co-host of Bloomberg Markets, the European Close, actually in studio in New York, which is a particular treat. It's been a busy day for you, and obviously speaking to some of these airline CEOs, it seems like if you're in the business of running an airline right now, you need to be focused about the U.S., but also the international stage, geopolitically speaking as well.
So there's so much going on. If you want to know what's happening in the global economy, Katie, you look to an airline CEO. Everything comes onto their desk on a daily basis. Geopolitics, as you mentioned, what's happening with oil prices, what's happening with the economy, what's happening with consumer demand, what's happening with corporate demand. It all comes to them. So they've got a pretty good view of what is happening. So it's fascinating to see Ed Bastian there talking about the softest of landings. Like everybody talks about landings. This is right in their wheelhouse, isn't it? Yeah. Is it a hard landing or is it a soft landing? They don't, at the moment, domestically, see much wrong with this economy. And it's going to be interesting to see whether that works out through the fall, Romaine.
I am curious, though. I mean, Ed has been relatively bullish, at least on his company. I wonder what you heard out of Virgin Atlantic and even some of the other airlines that you've spoken to, whether they share in that same sort of sentiment.
So I think Virgin is a little bit more cautious. Europe, I think, is in a very different place than the U.S. economy is right now. Shai Weiss also has exposure into what is happening in Israel right now. You saw what Kirby said over at United, talking about quite a big impact if that conflict continues. U.S. carriers, though, do have some headwinds that European carriers don't have. They're not hedged in the same way when it comes to fuel. So they're having to take that hit a little earlier than maybe some of the European carriers are. But we are starting to see, particularly at the low-cost carriers, a slowdown domestically. Yeah. And you do wonder ultimately whether or not that is going to go into the full-service carriers, who are at the moment benefiting from a much stronger U.S. economy. So it means people do actually want to fly with a more premium product, and also the international product, which is still much stronger than the domestic product is here in the U.S.
All right, Guy Johnson, of course, the co-host of Bloomberg Markets, the European Close, and his interviews that sit down a little bit earlier with the heads, two airline executives, the head of Virgin Atlantic, as well as Delta. We do want to stay on this topic here and speak with Helane Becker, Senior Research Analyst over at TD Cowen. And Helane, I want to pick up where Guy left off here and the idea of the difference between what we're seeing in the domestic markets, particularly when it comes to leisure travel, and what we're seeing in international markets, particularly when it comes to some of that corporate travel.
Yeah, we're seeing, it's kind of interesting because it's a tale of two airlines almost. We're seeing increased international travel to leisure destinations. Inbound international travel, we're seeing a pickup in business travel. And for the domestic U.S. market, we're definitely continuing to see strength in leisure markets, but we're not seeing the day trips anymore in business markets that we would have seen pre-pandemic. I think between all the delays that occur when you're flying, you can't necessarily count on being able to go in the morning and come back in the afternoon or the evening anymore because of flight delays and cancellations. So I think those one-day business trips are being replaced by Zoom calls and other calls. And the multi-day trip is coming back.
Well, Helane, name some names there. When you talk about maybe the day trips going away, being replaced by Zoom, who among the big airlines does that hit the hardest?
Yeah, so I think when, it depends on the market, of course, right? So think New York to Boston, that's going to hit Delta and American and United out of Newark. New York to Atlanta, that's going to hit Delta, American, JetBlue, and United. San Francisco to LA, or the other way around, that will hit Alaska Air, that will hit United, and that will hit American. Delta has a little bit of service in that area, in that market as well. So it depends. And we're also seeing, actually, before I say the other thought I had, we're also seeing Southwest pivot away from a lot of business market service into more leisure destinations.
One thing I'm curious about, Helane, if you can shed some light on, it does appear also, in addition, when we talk about the difference between leisure and business and international and domestic, there also seems to be a little bit of a difference now that we're seeing in terms of economy, coach class, if you will, and some of the more premium cabin classes like business class and first class, to the extent that some of the commentary on the American Airlines call, and I think if I remember even from Ed Bastian, this idea of putting more of a focus on the economy passengers, or at least finding a better way to monetize them.
Yeah, I think you're seeing more market segmentation, which you never would have seen, a decade or so ago. Analysts like me have been telling airlines for a really long time now that there is a way to segment the market. When you think about hotel chains, for an example, segmenting from the least expensive to the most expensive and what you get for your money. And I think the airlines have finally figured out that people are willing to pay for a better experience and are willing to buy up to premium economy or even into business class, especially if it's a reasonable cost. I mean, historically, you hadn't really seen what you saw historically was a huge differential between business class and the least expensive economy fare. And that differential has narrowed a lot. And A, and B, a lot of the bigger airlines, the big three especially, were sort of saving some of those seats for their customers so that they can offer upgrades. Well, they figured out that their customers are going to fly anyway, so they might as well make it as paid as possible. And you've seen paid business class and paid premium economy increase pretty significantly in the last year and a half.
All right, it'll be interesting to see how much longer this keeps going. Helane, always great to talk to you.
Exactly.
Yeah, exactly. Helane Becker over at TD Cowen. She laughs because she knows better than anybody else exactly how this industry works. When we come back, we're going to focus in on another industry, housing, real estate, getting hit from all sides. We're going to have a conversation after the break with Joshua Pristaw on how real estate portfolios are changing as higher rates bring low supply and demand to housing. This is The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, of course, we know the real estate market. Some people would say there really is no real estate market right now because there aren't a lot of transactions, whether you're talking about commercial real estate or even housing real estate right now. But that could potentially change.
Well, I've heard rumors to that effect, so we're going to find out right now how the real estate market is doing. We're going to turn to Joshua Pristaw. He's head of real estate at Pretium. That's an alternative asset firm that invests a lot, particularly in residential real estate. So, Joshua, thank you so much for joining us. Let me start with exactly where Romaine was. Is the housing market broken?
Well, first of all, thanks for having me here. It's a pleasure to be here. As you mentioned, Pretium's a $50 billion alternative asset manager really focused on residential housing. So, no, I don't think the housing market is broken. But what we're seeing is that supply is being destroyed faster than demand as a result of rising rates. And that's really a function of what we call the mortgage lock-in effect. So the average in-place mortgage is about 3.6% interest rate. People can't afford to move to a smaller house, let alone a larger, if their 30-year mortgage is going to more than double.
So if there are real problems in the residential real estate market, what's the solution? I mean, we're getting used to higher for longer, right? And people are saying, well, companies can adjust. Can the real estate market adjust to these sorts of 8% mortgage rates?
I think it can adjust. First of all, if you look historically, it's not unprecedented. It's been a long time since it's been that high. But the real solution resides with building more supply. And that's where we're focused, particularly in something we call build to rent. We're in the single family rental space. So we're focused on building new homes for rent in ownership communities where people can get access to good schools and proximity to good jobs.
But how fast can you actually do that? I mean, that's always been the question here is we know we have a housing availability issue here, particularly when it comes to affordable housing. But just to break ground and get that stuff up and running, depending on the municipality, can take years.
It takes time. It can take years. I think what you're seeing in some parts of the country is regulatory changes to stimulate more development of housing, things like accessory dwelling units where owner occupants can actually build on their own lot and create more housing supply to the market. That's part of the solution. We have really deep and enduring partnerships with home builders where we're trying to give them visibility in their business to dampen volatility, to know that we'll always be there for a certain number of homes. So they'll sell to owner occupants and they'll sell to us and we'll rent them out. And we're having great success doing that.
Are there regions that are going to offer better opportunities for doing that than others?
Well, I was on a show at the end of last year, and I'm happy to be invited back to Bloomberg, but I made the statement, follow the U-Hauls. We continue to see the best value long-term in the states that are in the smile of the country, Southeast, Southwest. Now, that doesn't mean that there aren't great opportunities in other places, but where people are moving and where the job growth is generally where there's not enough housing.
When you talk about build to rent, is there the financing available to build to rent? I mean, certainly in the commercial real estate area, I understand you're residential mainly.
Yep.
Commercial, there's a real pressure being put, particularly on the banks. We talked with Fed Chair Jay Powell last week about that very thing. This is what he said.
So there's work from home, and that's affecting downtown real estate in a lot of big cities, and higher rates as well, as you point out. So this is an issue that we pay a great deal of very careful attention to. Commercial real estate is not a principal risk or a major risk for the very largest banks. Right. It is much more for regional and really the smaller banks have proportionally a much larger exposure to real estate.
So there you heard Jay Powell saying it's a real problem for the regional banks, not the big banks, the regional banks on commercial real estate. Is there an equivalent problem with residential?
Well, there's a different problem for the market there, which is about 70% of all acquisition and development loans. That's sort of the nuts and bolts of how you get these things built. We're sitting with regional banks. But then when you think about the vertical construction of single family homes, 40% of that are done by private builders, and virtually all of their financing came from regional banks. So about a $90 billion financing hole needs to be filled somewhere. Our expectation is that what happened in private equity with a migration to private credit is what is going to happen now in residential credit. Is there will be an emergence of new players that replace the regional banking system in financing the home builder construction.
One of the things that I haven't quite understood is, given all the tightness in the housing market, why are rental rates going down at this point?
Well, I think there's a divergence between the type of unit you're talking about. So there's a divergence between multifamily and single family. We happen to be an operator in single family, and that's really demographics driven. So if you look at the millennial generation is now reaching peak household formation age, 35 to 49. And study after independent study shows that at that age, people want a house. So we're not building enough homes. Rents are rising for single family rental. But over the next 2 years, you have record deliveries of multifamily, just as millennials are moving past that demographic age when they want a home.
I am curious, not to sort of pit generation against generation, but how much should we blame the baby boomers for this? Because I'm told that they're not moving, they're not giving up their houses, they got their multiple homes, and that's exactly, in all seriousness, but it does seem to be evidence that is also exacerbating the situation. And at some point, they're going to move on, obviously.
Yeah, so we call that phenomenon aging in place. Okay. And what used to be is that the home ownership rate, when you hit about 65, would drop precipitously. But like in everything else with the baby boomer generation, they're behaving differently. And so they are something like 10 percentage points more likely to be homeowners. And that home ownership rate doesn't decline until they hit about 84. So that if you think about that, that's 10 percentage points of homes across 40 million baby boomers is 4 to 5 million homes. So when people often ask me, well, where did all the homes go? The answer is grandma and grandpa still live in them. They haven't moved yet. But I think that's another 10 years or so before that changes.
I don't know if you noticed, but we boomers don't like to leave the stage. We want to stay on that stage as long as we can. It's all over the society. Thank you so much, Joshua. Really great to have you as Joshua Pristaw. He's head of real estate at Pretium. And later this week on Wall Street Week, that's coming up on Friday, we're going to be joined by Tom Nides, fresh back from being U.S. Ambassador to Israel. He now is vice chair of Wells Fargo. He understands what's going on in Israel and the Middle East better than just about anyone, both from a point of view of geopolitics, but also in terms of the business community. That's going to be coming at 6 p.m. Eastern time on Bloomberg on Wall Street Week. Romaine?
Yeah, definitely something to look forward to. And David joins us every day around this time for our Wall Street Week daily segment as we close out the first, we head into the final hour of trading here on the first trading day of the week here. Of course, the big story earlier this morning was that big spike that we saw in yields. But as you can see on the screen there, that has reversed in a pretty significant way. A mixed bag right now in the equity space, but the volatility pushing a lot of folks to the sidelines. 160 S&P 500 companies reporting this week. We're going to have full coverage of all of it. Stick with us. This is The Close on Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top in financial markets. I'm Romaine Bostick.
And I'm Katie Greifeld.
An S&P 500 that opened lower. In fact, most of the major indices opened lower on the day, Katie Greifeld. And you saw some key retests of a lot of those main moving averages. But it's kind of been oscillating back and forth. You're looking at S&P now back in the green. We should point out the NASDAQ composite also higher on the day by about 1%.
And you talk about the bond market. Let's do it right now because 5%. We got there and then it quickly went away. That was actually the first thing I saw when I woke up was the alert on my phone that we broke 5%. But what a brief, sweet dream.
Brief, sweet dream here. And it gets to this idea here of whether there's more to come, whether this drop we're seeing right now is maybe just a little bit of a reset and we shoot back higher. Who knows here? It's interesting, too. You were talking a little bit earlier about Bitcoin. We don't talk about Bitcoin much.
No, we really don't. We're talking about it today, though, because it's above 31,000 for, I believe, the first time since July.
Wow.
Bitcoin trades 24/7.
I've
sure
heard.
You've heard that before. It staged quite the weekend rally, and it's continuing today.
Flip up the board, though. I wanted to show you something here, because you said you were up looking at the 5-year yield going up. I don't know if you saw what happened in Asian markets, particularly in China here. This is actually a huge sell-off we're talking about now in a lot of the main Chinese indices, including some of the main tech indexes, which are down 10, 11, 12% here on a year-to-date basis. Right now, you're taking a look at some of the breadth that we've seen in the Shanghai Composite with more than half of those members, individual members, below those key moving day averages here. And there really just seems no end in sight here. There just is no upward catalyst right now for folks to come in and buy Chinese stocks.
Yeah, and I mean, you take a look at that chart, it seems like that's been the case for a while, that we've been lacking an upward catalyst. But let's go back to the U.S. equity markets and look at some of the individual movers, because there's quite a few of them today. I want to start with Walgreen Boots Alliance. So this is moving on the heels of an upgrade from JP Morgan, rating the weighting to overweight from neutral. There are a bunch of different reasons, but part of that ties back to the new leadership. CEO Tim Wentworth coming in. The analyst noted that there's clearly work to be done, but noting the refreshed healthcare-focused management team. That's worth about a 5% rally.
Yeah, he's got a lot of work ahead of him.
Yeah, that's for sure. But stock is rallying today. Of course, we have to talk about Hess, the Chevron Hess deal. It's interesting. You actually take a look at Hess shares right now, and they're lower. They had popped earlier in the day, as you can see, but now some of that is coming off. Not typically what you see when you see a $53 billion deal announced. The acquirer typically rallies. Seems like that's not the case today. And I just wanted to quickly talk about Apple, because they had been nursing 6 straight days of losses. That was the longest streak since January 2022. That is snapping today, up about 0.4%. We'll see if that holds. And we do have big tech kicking off this week. Apple, though, reports next Thursday, so we'll have to wait.
Yeah, a big part of the reason why you're seeing the S&P in the green as well as the NASDAQ is because of Apple and, Frank, all the Magnificent 7 stocks in the green, including some meaningful gains by NVIDIA up 4% and Meta Platforms up about 3% on the day. Amazon not left out either, up about 2%. We are about 1 hour away from those closing bells. Our cross-platform coverage of the top stories of the day starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across Bloomberg TV, radio originals, and our partnership with YouTube. Carol's smiling. We got New Jersey in the house. We got Brooklyn in the house.
We're all
Tim
in blue,
represented.
too.
Shy in the house. Yeah, we're all, well, not me. But anyway, Carol,
yes.
I thought of you this morning because all the talk was about this Chevron Hess deal.
Yeah.
And all about, you know, that oil off of Guyana that they're trying to get. But I think the real impetus for this deal was so that Chevron could get his hands on those little toy trucks that I'm sure you must have had as a child. Because I feel like you can be in New York, New Jersey in a certain generation and not have had one of these trucks, right?
Hey, if you're in New Jersey, you're a trucker. What can I tell you? I had 4 brothers. I mean, no, if you think about it, they've been around since 1964. So I thought the same thing when this deal crossed. I'm like, what happens to the Hess truck? Do we still get them at holiday time? Having said that, I feel like you guys and we are all obsessed about kind of, it feels like a resurgence in deal making. We're going to talk about that in just a moment. But this big energy deal, there's been a lot going on in this space. And I love what Alex Steele, we're going to talk to her. I know you guys have been talking to her. It's all about this deal buying inventory rather than having to build it out. It's maybe unbelievably, what is the deal? $53 billion. That's a maybe cheaper way than having to do the E&P and then build out the infrastructure.
Okay, but back to the most important part of this story, which is, of course, the Hess trucks that Romaine brought up. I want to assure all of you, and we have a story about this right here on Bloomberg News, that Hess is going to continue selling those toy trucks even after this deal closes. Here's what the company said in a statement. We want to reassure all of you, our loyal fans, that the Hess toy truck will continue for future years.
What's it called, though? Chevron Hess?
No, it's going to be called Chevron. And the Hess family will actually be among the biggest shareholders when the deal closes, since it's an all-stock deal.
So there you go. You can breathe easy. You're going to get the Hess trucks around Christmas time. But of course, the interesting question here is what this means for the rest of the energy industry, whether we see more consolidation. And that would kind of fit with the trend that we've really seen in the month of October. There's a great story on the terminal that so far October is the busiest M&A month in years. We've seen about $139 billion in takeovers announced so far this month. That is the busiest month since June 2019. It's about triple what we saw this time last year.
I guess that's good. The one thing I do think is interesting is how these deals are being financed. I mean, the Chevron deal, if I remember, that's all stock. A lot of the other big deals have either been cash or stock. You're not seeing a lot of financing going on for these types of deals right now.
No, that's a really interesting part of this. I'm also thinking about with the energy deals specifically, I think our Javier Blas kind of writing about some of the premiums or lack thereof that we are seeing, because I thought it was interesting that both Chevron, not surprised to see them down in the trade today, but Hess was also down as the target. So maybe investors are a little disappointed about the price.
And look, it makes sense that we're not seeing financing with interest rates where they are. I think what's also interesting and notable about this is that this is a certain type of deal that's happening. These are takeovers. We're not talking a lot about IPOs. Sure, there were a handful of them this fall, but Romaine, as you've pointed out many times on air before, they have not gone very well thus far. So I don't see this being like sort of a rekindling when it comes to at least IPO deals.
Yeah, that's what we were talking about a little bit earlier, too. This fact that you are seeing a lot of M&A, not so much in the IPO market, and the ones that do come public, not a lot of love. But even so, we were having a great conversation earlier that, okay, maybe IPOs are back, but SPACs, et cetera, some of the froth that we got really familiar with 2-3 years ago, maybe we have to wait a little longer for that.
With the 10-year at 5%, you know, are we going to see SPACs?
I don't know.
No, I don't know. That was a wild time. In fact, it was kind of fun, to be honest.
It was kind of fun.
Yeah, I'm not sure it was like financially responsible, but.
No.
SPAC, maybe not back. Hess truck, it's going to be
here forever.
All right,
Better
good
than
stuff.
ever.
Phew, we were so worried. All right, guys, we're going to be back in less than an hour's time. Our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals. We're going to count you down to the close on this Monday. We'll see you at 4 p.m. Wall Street time.
All right, let's talk here, right here on Bloomberg Markets, the close, counting you down to those bells. A little more than 50 minutes to go here, and we talk about, well, the biggest bond market out there is in the Treasury space, and a lot of people were betting for those prices to fall. Billionaire investor Bill Ackman, though, says he covered his short bet on U.S. Treasuries, explaining that there's just too much risk in the world to remain short bonds at current long-term rates. Let's get some analysis out of our next guest. LeBas joining us right now, Chief Fixed Income Strategist at Janney Montgomery Scott. And I mean, last time I checked here, Guy, I think we started the year around 3.9% on the 10-year. At some point on the day earlier today, we got above 5%. So a lot of those people who were really sort of betting for to see a drop in yield certainly were proven wrong. But there are a lot of people now looking at 5% and saying that's got to be the top.
Well, I wouldn't say it's got to be the top at this point. I mean, the momentum behind the selling pressure, this one trading day aside, has been extremely strong. And in fact, we've really seen a pretty persistent move higher in long-term yields since we saw the emergence of a non-economic seller of long-term bonds namely the U.S. Treasury Department. Back in August, the Treasury increased its longer-term coupon auction sizes, and from there it's been pretty close to a one-way trip higher. They're not done, right? We've still got some while of heavy issuance to come, and a market that is maybe hesitant to absorb some of that.
I am curious as to when these yields start to become attractive for the average investor here. We're basically 5% across the board from the short end to the long end, give or take a few points here and there here. But is there anything that you see right now that would give you a little bit more confidence in extending duration beyond just the shortest of short term, which has been the trade for a good portion of the year?
Sure. Well, we've been advocating for clients that we barbell portfolios and have at least some exposure to intermediate to longer-term bonds while concentrating more heavily on the front end of the yield curve because, A, it offered greater carry with short-term interest rates relatively higher, and B, it did so for substantially less risk than going further out the curve. Granted, now that we've hit near or trading at near that 5% level, the trade-off is a little less obvious. However, I suspect the upside risk to interest rates and the downside risk to prices is probably a little bit closer in a severe case scenario, not to the 5% we're trading, but conceivably within the next 12 months to the 6% that we could see. I emphasize could here because it would require a really unusually long sustained period of economic growth, which at this point in the cycle is rare, but there are examples in history where that has happened.
And Guy, next week is going to be a lot of fun because, of course, we have the Fed meeting, but we also have another refunding announcement. As you rightly pointed out, it was the refunding announcement in the summer that made things get so weird. When you think about next week, what's more important? Is it refunding or is it the actual Fed meeting?
Well, I think a lot of things came together at the same time starting in August that are beyond just either the Fed meeting or the refunding. It was also the Bank of Japan relaxing some of their constraints on the yield curve control. And that has the effect of adding substantial amounts of duration onto the market as well. So it's not one or two things that are the most substantial, but it's a combination of all these things happening at the same time. And I like to joke that supply, from the Treasury Department in this case, supply doesn't matter until it becomes the only thing that matters. And right now it is, and I suspect we're going to need even higher clearing levels before sort of the household sector comes in to absorb that substantial amount of Treasury issuance later this year and early next.
And you've also seen that supply work itself into some pretty sloppy auctions. I mean, especially if we think about the 30-year a week or two back, obviously a big tail there. Is that the dynamic that we should get used to, this primary market weakness?
Yeah, so with that 30-year auction specifically, I mean, we were really tied up in sort of the risk-on and risk-off themes around the Middle East conflict. I think that specific period is likely behind us at this point, or the extremes of that period are likely behind us at this point. At the same time, what it does tell us is that nobody is willing to pay up for that incremental supply. And I think that is probably something we will see a few more times. I doubt we're going to see those extreme 3.5, 4 basis point tails. If I recall, a 30-year auction tailed 3.7 basis points that day. We're unlikely to see that severe.
I want to talk a little bit, Guy, here about kind of what signals are actually coming out of the bond market, particularly when it comes to the structure of the yield curve, the re-steepening that we've seen on a couple of key parts, and the idea of a disinversion and whether that is the harbinger of doom that maybe it was in the past.
So usually at this point in the cycle, we see some form of slowing economic growth, and the Federal Reserve either begins to cut interest rates or starts talking about cutting interest rates, at the very least balancing risks between rate hikes and rate cuts. That's clearly not what we see this time around. So in that scenario, historically, again, at this point in the cycle, typically, we see short-term interest rates begin to decline at the same time that longer-term interest rates either remain steady or maybe even rise a little bit. We are not seeing this. Instead, what the markets are kind of implying is that some combination of supply or the potential for economic growth to extend further than normal at this point of the cycle is causing the yield curve to re-steepen, led by the long end higher. And that's certainly been a pain trade for fixed income investors, at least for those of us who don't have large steepeners on. Now, going forward, right, it's going to be a little bit tougher now that the yield curve is much flatter. However, there are some sort of mechanical things that I think require a steeper yield curve, again, over the next 3 to 6 months in order to clear the incremental Treasury supply.
I want to talk a little bit more about the signal, because when you think about the bull steepening, as you were describing, typically that's the recessionary signal. And what we're living with now, of course, is that bear steepening. And when you pull apart the different dynamics, because it's a bear steepening, does that lessen the potential recessionary flag that we're getting?
I think it does, very much so. And I think there is a possibility that the U.S. bond markets are one more piece of evidence signaling, and I referenced this a couple moments ago, the potential for higher productivity to lead economic growth a lot longer and perhaps even a lot stronger than is typical at this point of the economic cycle. We've seen lots of other pieces of indirect evidence as well. I mean, I could point you towards Thursday's incoming third quarter GDP release as a possible example. Pretty good odds we're going to see 4%, even 5% type GDP growth for this quarter at a time when that shouldn't theoretically be possible. That's a sign that maybe we're seeing some growth in productivity that could pull economic activity forward a lot further, a lot longer, and maybe even a lot stronger than it has normally at this point of the cycle.
Guy, it's great to get some time with you. Our thanks to Guy LeBas of Janney Montgomery Scott. Now coming up, we'll speak with the global head of ETFs at Morgan Stanley Investment Management, Tony Rockty, about their new slate of ETFs.
And a closer look at Salesforce. The stock is gyrating, had been lower on the day. We're going to discuss what's been going on at the cloud company.
And we'll count you down to the closing bell with Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. All that and more coming up. This is The Close on Bloomberg.
43 minutes until we get to the closing bells here on this Monday afternoon. Microsoft, Amazon, Alphabet, Meta, in fact, all of the Magnificent Seven higher on the day. And it's really a big part of the reason why you haven't seen more of a downdraft in this market. That's because you have some other big names out there, including the banks, including Intel, including a lot of the healthcare names, as well as a lot of those oil and gas names, all moving lower here on the day. But when you have Apple up, when you have Nvidia up 4%, Amazon up 2%, you end up with the NASDAQ 100 higher on the day as well. 0.7%. A modest gain to be sure. Similar moves on the S&P, which is up about 3 to 0.4% here on the day. And you're taking a look at a 10-year yield that has been tamped down from the volatility that we saw early in the session here. That might be another reason why you're seeing a little bit more optimism on the equity side of the equation. We should point out that over in Asia and in a lot of the emerging markets, they have not been spared. Significant downdrafts that we saw in a lot of the main Chinese indices as that slump continues. And take a look at the Merval over in Buenos Aires, a surprise surge in one of the key opponents in that presidential race, really catching the markets off guard. Their stock market was down 10% on the day, but more importantly, the activity we saw in their bonds, something that we haven't seen in more than a decade. Meanwhile, back here in the U.S., we are seeing volatility in the Treasury space, but how about the equity space? Abigail Doolittle joining us right now for our Options Inside segment, as she does every day at this time. And Abigail, I'm taking a look at the VIX. It's down on the day, but still above 20.
It is. It just flipped right above 20 moments ago. Romaine, it had actually been below 20. And 20, as you know, symbolizes that there's less complacency from a longer-term perspective. VIX at 20, that's basically where you want to see it. Now when we see VIX at 20, some concern for some investors might creep into the picture. Scott Bauer, CEO of Prosper Trading Academy, you are a true expert on VIX. One time, about 2 years ago, you took us through the math on it. So we have had VIX go from basically 15 to last week it was as high as 23, certainly elevated, but to Romaine's point on the day down, and the S&P 500 up ever so slightly right now, testing its 200-day moving average. How do you put all of this together, bullish or bearish?
You know, overall, I would say I am moderately bullish, not bearish is maybe a better description. And here's the reason why. Especially when looking at the VIX, Abigail, the put-call ratio in the VIX is typically inverted. So what we would normally see, you know, in equity put-call ratio is 1-to-1, maybe a little bit higher than 1-to-1. In the VIX, what we're seeing is normally about a 0.4 to 1, meaning that there's about 2.5 calls for every one put that trades, and that would be, you know, inverse to the regular markets, because calls on the upside in VIX means people want protection of the market going down. Well, recently, what we have seen is that flip, and we're seeing a put-call ratio now almost 1-to-1, which tells me that people are right now, retail anyway, not really expecting the VIX to go that much higher in the near term.
Okay, so that's retail. Last week, though, we did have that VIX curve inverted slightly, so a little bit of backwardation. And so when that happens, if it gets deeply inverted, basically the VIX index itself is above futures, which would suggest that there's more uncertainty around the moment, the near term, than there is further out, which is a little bit not the way it should be. Is that of concern to you? And especially, again, you have this S&P 500 kind of below, right around that 200-day moving average. The Russell 2000 well below it. Oil looks, it has not happened yet, but it looks like it could break to the downside. It looks as though we could see some more selling in risk assets, but you're not really seeing many signs of that?
I'm really not, but you're right. You have all of these factors coming together. And don't forget, not only the big earnings this week, but we've got the Fed next week. So you have got so much of this dynamic all coming together that really is just ripe for a risk-off scenario, but I'm just not seeing that in the VIX trading. And when I look at some of the individual equities also, if we throw out some of the stocks that have earnings this week, individual equity implied volatility is actually not that high, Abigail. I would have expected it much higher than it is right now.
I forgot all about the Fed next week. It's amazing how that November meeting is all of a sudden going to be here. Scott, you do of stocks that could potentially be going higher. You like the big banks. Talk to us about JP Morgan in particular.
I really like JP Morgan. I think the banks, as many of sectors, are really oversold. But when we get in a period of time like this, I really want best in class. And JP Morgan, to me, is best in class. It's also right down near its 200-day moving average. So technically, the fact that it's oversold. So I really like some upside here. I'm buying November regular calls. So November expiration, the 145 calls, you can buy those for about $2, $2.25. I really think we're going to see a pop here in JP Morgan.
Nice way to play that potentially. Scott Bauer, CEO of Prosper Trading Academy, thanks so much for joining us, as always, for Options Insight. And from New York, this is Bloomberg.
Well, Americans are falling behind on their auto loans at the highest rate in nearly 3 decades. To get specific here, Romaine, the percent of subprime auto borrowers at least 60 days past due on their loans rose to 6.11% in September. That is the highest in data that goes back to 1994.
Yeah, and this isn't surprising. We've seen, of course, the cost of cars go up over the last few years. And, of course, those payments went up. Of course, that wasn't too bad when those payments were most likely going to be in the single-digit percentage range. Mm-hmm. But now, of course, even folks with good credit are probably going to have to maybe get into high single digits, maybe into the double digits, and that changes the dynamics a lot. You have people that are sitting there on like $1,000 car payments, which, you know, I'm old enough to remember when that was enough to buy a house.
Yeah, and I mean, it just folds into all these conversations that we've been having about the cost of living is just going higher and higher. When you think about rent, you think about housing, you think about car payments. I mean, it's just getting more expensive. And I mean, that's Fed policy in action. It's
Fed policy in action. And you wonder when they kind of wake up to that, right? I mean, there's the anecdotal evidence is there. Now, whether it shows up in the aggregate data to a point where they're willing to do something remains to be seen, but we know it's there. And if you're having to pay more for a car, more for your rent or your mortgage, things like that, that means it's less on discretionary things and a lot of the things that help to boost this economy.
And we'll see that work its way through the data if it does. But again, that goes back to the tightening financial conditions. This is what it looks like. Much more markets coverage coming up. This is The Close on Bloomberg.
This is the countdown to the close. About 30 minutes left to go here on this Monday afternoon trading day.
30 minutes left to go. You have the S&P 500 just flipping into negative territory. There's still some gains to be found if you take a look at the sector level. Up at the top, you have communication services up about 1%. Big tech, too, hanging on to gains. The infotech sector up about 0.5%. Consumers discretionary still looking at gains as well. But then you go down the list, and there's a lot of red to be found. Real estate, materials, energy at the bottom of the pile. Energy off by about 1.8%, Romaine.
Well, the good thing is right now, Katie, is that the magnificent and 7 are doing what exactly the market wants them to do, and that's move higher. Meta Platforms up 2% here on the day ahead of their earnings this week. Don't forget, we also get Amazon as well as Alphabet later in this week as well. Meanwhile, keep an eye on the software names here. An interesting downgrade or reshuffling of ratings, I should say, by Piper for about 16 companies in the cloud space here. A downgrade for Unity and Salesforce. Unity right now down 3%. And remember, Unity has had some idiosyncratic problems that go well beyond what Piper is focused on. Meanwhile, Coinbase getting a boost up 4% here on the day as Bitcoin at one point was trading around 31,000, and now some optimism or a speculation, I should say, about a potential ETF finally getting approval. And one of the big decliners on the day, FMC Ag Chemicals down 13% off the back of some disappointing guidance. Katie?
Well, let's go over to the ETF world because it's my favorite place to be. And I'm thrilled to say that we have Morgan Stanley's global head of ETFs at Morgan Stanley Investment Management joining us right now. You had some very interesting launches last week, both from the parametric side of the business as well as Eaton Vance. But I want to start with the parametric products because we have the parametric equity premium income ETF. The ticker there is Poppy. And looking at this ETF, of course, it has that options overlay strategy. Seems somewhat similar to a JP Morgan product on the market, so some pretty stiff competition. What's the differentiator?
Yeah, so we heard a lot of demand from clients in this category. We've seen a doubling of the assets in the Morningstar category. What's different about Poppy, ticker PAPI, is number one, a stable, durable dividend yield, but very tax efficient. So we've really focused on the tax efficiency of the income stream. The second element is the options overlay, powered by Parametric. They've been doing this for over 2 decades. That's different. In addition to priced at 29 basis points, it's almost a third of the Morningstar category average at 87 basis points. So low cost, very tax efficient, and of course, with a yield target of 7 to 8%. So that's how we're differentiated.
And Tony, I'm not sure if you saw it, but there was a really interesting analysis out by Citigroup a couple weeks ago talking about the cost of running an ETF. And as you see this race towards zero, this march towards zero, these very low cost products, a lot of them aren't necessarily covering their operating costs. Of course, you just started these products, but how do you think about that as you wait to accumulate assets? How long of a lead time do you plan to give some of these products, not specific to Poppy, but when you're thinking about building out your ETF business?
Look, it's a $7 trillion market. We've seen over $500 billion in U.S. ETF flows initially. When we look at Parametric, though, they've served institutions specifically in the option overlay business for over 20 years. So I think we have the scale, and I think with this new ETF from Parametric, we're really bringing this capability to a broader audience.
In the fixed income space, in the ETF space, that is, with fixed income, how much has that sort of broadened out in terms of both the offerings in the ETF space, but more importantly, the actual appetite for it from customers?
No question. There were regulatory changes in 2019 that accelerated active ETFs. If we look this year as a category, over 40% of the ETF flows in the U.S. were fixed income, yet only 19% of the assets are fixed income. So we're seeing a huge appetite. That's one of the reasons we brought Eaton Vance actively managed ETFs to market as well last Thursday.
What's the challenge, though, in doing that, particularly on the active side? Because when we talk about the lower liquidity, if you will, relative to equities, and even just the general idea of finding enough bonds and things, enough supply to sort of meet whatever the size of the ETF ends up being.
Yeah, I mean, look, it depends on the exposure, but we've seen price discovery in the fixed income market, just like we saw for decades in the U.S. equity market. And I think as more entrants enter the market, like Morgan Stanley Investment Management, Eaton Vance, you see spreads tighten. But it certainly depends on the asset class.
And I want to go back to Poppy because this conversation about fixed income ETFs, I actually phoned a friend for this segment and asked Eric Balchunas what he would ask you. He raises the point, what would you sell in your portfolio to make room for Poppy? Because you think about the fact that you're selling call options, you're generating that extra income. Does this replace fixed income or does this replace equity in a portfolio?
Yeah, what we've heard is investors want downside protection. And they also want an income stream. So candidly, they like both. But what's interesting about this, it protects on the downside and also provides that 7 to 8% income. We have heard financial advisors have actually carved out a sleeve of their fixed income exposure just for these type of instruments. And I've certainly talked to Eric about that.
I would imagine so. And I know that also Morgan Stanley has filed to convert some of its mutual funds into ETFs. And again, as you build out this ETF business at Morgan Stanley, how are you thinking about launching new organic ETFs versus conversions from the mutual fund business?
Look, we're building out a multi-brand global platform. By the end of this year, we'll have 11 ETFs in market. We're primarily focused on active management, both equity and fixed. We'll continue to evaluate building block versus specialized, but it's an incredibly important segment because we're serving the needs of both institutional and financial advisor clients.
Are they asking for more active options, active management options?
Again, this year, I gave you a stat on fixed income.
Yeah.
If you look at that same market in the U.S., almost 30% of ETF flows this year were actively managed, and it's only about 6% of the assets. So the answer is yes. The financial advisor that serves the individual investor is looking for both active alongside passive.
I want to meditate on active for a little bit, because when we're talking about active in the context of an ETF like Poppy, of course, the active component comes from the fact that you're managing the options book. Whereas, some people hear active and they think stock picking. So it's active, but it's a different type of active. Yeah,
interesting. We launched a second ETF alongside Poppy, parametric hedged equity, last Thursday, ticker PHEQ. That's actually aimed at equity exposure while protecting on the downside. So we implement the parametric custom core, which is an optimized S&P 500 exposure alongside the option overlay, and we're targeting 40% less risk to the equity market. And so if you can protect on the downside, think about it this way: you can re-risk a portfolio, right? You can actually step into the market, or you can actually de-risk a portfolio, allocating from maybe something that's a little more aggressive into PHEQ. So that's really the mindset.
It's really interesting, active for downside protection versus active for the moonshots that are out there. Tony, we got to leave it there. Really enjoyed it. It's great to see you on set. That is Tony Rockdy of Morgan Stanley Investment Management. Now, coming up on the close, shares of Salesforce under pressure after a change of heart over at Piper Sandler. We'll have more on that next in our Stock of the Hour. This is The Close on Bloomberg.
Time now for our Stock of the Hour. A closer look at Salesforce. The shares slipping after Piper Sandler downgraded the stock along with 15 other companies in the software and cloud computing sector. Bloomberg tech reporter Brody Ford joining us right now with a little bit more on this. And this was an interesting note here. We actually spoke with Braceland, the analyst, last week about Microsoft, which he was kind of buying into this growth story there. The note here on Salesforce, Unity, Asana, and some of these other names seem to be predicated on the idea that sector as a whole, that growth rate that investors had gotten used to, that's a thing of the past.
Yeah, so late last year, every software company said, hold up, it's getting rough, it's slowing down. Yeah. But then they started this year with the big AI acceleration. Everyone got excited, and they said, for the most part, that 24 is going to be better than 23. But we're starting to see signs that reacceleration might not come in. And probably there's no better example than Salesforce, as you said, because they focused so much on profit at the beginning of the year. And now all the investors are getting scared that, that really might eat into the ability to reaccelerate revenue.
And is that what we've already seen play out in the shares? Because, of course, this downgrade follows, you could say it's been slipping. Salesforce had such a rock and roll start to 2023. It's come down a little bit from the peak. Is that basically that drop, some of those concerns already playing out in the market?
Absolutely. We've already seen some reckoning with the idea that growth might not come back as quickly as we expected. But for the most part, investors are still modeling for 2024 to see a growth reacceleration. This today was new because that Piper Sandler note was saying, hold up, it really might actually take longer than we even expected for it to come back.
So there's two things that kind of perplex me about this. A, on Salesforce, which I kind of feel like is almost an island unto itself. But this was investors, and for that matter, a lot of Wall Street analysts are basically saying, oh, no, they're spending way too much money. Benioff needs to rein it in here. But Benioff even pointed out, even before he finally agreed to do these cost cuts, that was sort of a big part of the growth story. Now, when you start to take an Asana, a Unity, Alteryx, and some of these other names here. I don't understand why you wouldn't want to see maybe a little bit more CapEx out of them in order to sort of generate growth in the future.
I think a lot of the notes that I see, a lot of folks I talk to will say that either give us high revenue or give us high profit. And the issue with Salesforce was that it started slowing down. They said, okay, well, you can't keep spending like a startup if you're going to have your revenue going down. But then just as you said, now especially with the AI story, folks are saying, well, maybe you do need to reinvest here. But as you said, it's hard. You can't have it both ways.
So when it comes to this specific note, specifically for Salesforce, noted an increasing risk of M&A. What does that mean?
That means Benioff is going to cut a check.
Right. Yeah. Well, that was a huge part of Salesforce's reckoning earlier this year of you guys got to stop buying giant things for giant valuations. And that message seemed to be received well. But now there's an idea that the AI wave is here. They're back in a reinvestment mode. Benioff told me a couple months ago, hey, we're going to hire 3,000 people. And that was a shock to many. And I think there's a sense that maybe management is feeling hot again. They might press the buy button.
All right, closer look here at Salesforce. Down only fractionally on the day. Bloomberg tech reporter Brody Ford helping us here with our stock of the hour. Meanwhile, we continue to count you down to these closing bells with about 15 minutes until we get the ringing. Lori Calvasina going to be joining us, head of U.S. equity strategy at RBC Capital Markets. Here on a Monday afternoon, Katie Greifeld, with stocks remain mixed. The gains that we saw in the S&P fading, the gains on the NASDAQ now starting to fade as well.
And today really feels like a holding pattern because we have something like $16 trillion of market cap reporting over the next 4 days. None today, though. So what do you do with today's market action?
Do they just take Mondays off? Why don't we get more reporting on Monday?
I'd rather take a Friday off than a Monday, but no one asked me.
Yeah, well, maybe they're taking a 4-day weekend. They take the Friday off and then the Monday, Katie.
That's smart.
You should try that sometime.
Something to think about.
All right. We'll be back in a moment here as we count you down to the close. Stick with us. This is Bloomberg. This is the countdown to the close. Romaine Bostick here alongside Scarlet, who joins us every day at this time to help count us down to those closing bells and take us to the bell and beyond. And before we talk about what happened in equities, we have to talk about what happened in the Treasury market. I don't know, somewhere around 5 a.m. this morning. I'm sure you were already up, Scarlet, plowing the fields there. But you probably saw the alert on your phone. 5% on the 10-year yield, something that we haven't seen, at least on a trading basis, going back to 2007.
Yeah, and it finally happened. We've been waiting for it for so long. There have been so much talk about it, and it feels kind of anticlimactic because it was there for all of 30 minutes, and then it retreated, and of course this volatility is driving all the other assets like U.S. stocks. The S&P 500 fell below 4,200 at the open, but before it bounced back, and now it's kind of fading once again as we head towards the close. Big question is whether it's going to end this 4-day slide. Yeah, to end this 4-day slide, I think some of the earnings that we get this week are going to have a lot to say about that. And don't forget, Scarlet, we're just I don't know, what is it, 8-9 days away from another Fed meeting? I know you're starved for Fed speak, but you're just going to have to wait one more week. I'm going to have to live without Fed speak for a week and a half. What am I going to do? I don't know how to carry myself. Let's see how our next guest carries herself. Lori Calvasina joining us right now, head of U.S. equity strategy over at RBC Capital Markets, to help us count us down to these closing bells. And I do want to start off with the Treasury market for a second, because that has been the tail that's wagging the dog. And it's not just about the level of rates anymore. It is about the volatility and these sort of extreme moves up and down. How much does that unsettle equity investors, if at all?
So look, I think it's the fact that we've had such a big move without interruption. If you look back over time, and we did a big study on this where we just went back to the 60s actually, so rising rate and falling rate periods, and we just looked at what equities do during different yield surges in the 10-year. And we found that if it's kind of a baby surge, so 275 basis points or less, equities tend to go up in that environment. They can handle that. But we've seen pretty consistently that when the yield surge is more than that, without taking a decent pause, that equity markets tend to go down. And this time around, if you use April as the starting point, we'll get to that threshold a little before 6%. So we've still got a little bit of room. We can get out of this without too much damage. But I'd be lying if I denied the fact that this is kind of the trouble spot. Like we're in a different place place now that we've hit 5%.
How comfortable, though, can you be, or any real equity investor be, if yields stay at this level? Let's just say the volatility tamps down. We don't get a meaningful jump up further from where we are right now. Is that something investors can live with?
So I think you do have to reprice your PE multiple, but our back testing, which again goes back to the 1960s, suggests that we can still sustain something around 20 times, which is a bit higher than most people assume. So you do have to pay a bit of a price. Your multiple is going to get clipped, but it's probably, you know, not as much of a clip as people anticipate. The other thing I would tell you is that if you look at balance sheets for corporations, whether you're looking at big cap S&P companies or Russell 2000 companies, basically debt is high, but it's long-term debt, and they've really locked in low interest rates. And so if you look at the effective interest rate on the debt outstanding, whether it's S&P companies or Russell 2000 companies, you're talking like 3.1, 4.4%. And so it is creeping up, but it does look manageable. And if you look at how companies are managing their balance sheets, they're doing less on buybacks. We've actually seen the S&P's dividend yield come down, but guess what? A lot of companies are talking about deleveraging. So they're really built to weather this storm, and they're managing it very prudently. This is more psychological than I think actual risk.
So companies are basically being much more discretionary about their spending, the way that consumers are being much more discretionary about their spending as well. The volatility that we've seen in bond yields, is it freaking out the market when it comes to reacting to earnings and earnings misses?
I don't know if it's having that direct of an impact on earnings. I mean, when we look at companies, and you saw this in the last Duke CFO survey, they said they're really worried about monetary policy. I think that was the biggest item that was on that list of worries. As I've been going through transcripts, and I'll be honest with you, I'm lagging by a couple days. I haven't quite, caught up with last week's late week deluge, but we are seeing a lot of references to uncertainty, sort of weighing on the corporate psyche, weighing on business decisions, weighing on the customers of the different companies we're reading about. So it is having an impact, but again, it feels more psychological at this point.
There are also a lot of political cross currents to contend with. You've got the Israel-Hamas war, you've got dysfunction in Washington, which in the short term is over whether we're going to get a shutdown. In the long term, the prospect of a really messy election. How's that showing up? How's that risk showing up in positioning, in money flows?
So I worry a little bit that the global investor is going to use all of that dysfunction as a reason to take money out of the U.S. And that's important because when you saw equity markets climbing this summer, we were seeing money coming into the U.S. while other geographies were starting to break down. So Europe has been seeing outflows. We saw a big turn in money that was going to EM in China while U.S. growth funds were taking in money. Now, actually, we've started to see outflows return to the U.S., but I think it's just a good reminder of why that global cross current is important. And if you talk to your average U.S. equity investor, they're going to be like, I'm not really doing much on the election. There's a little bit of question about tax policy and certain Trump tax cuts expiring, but that's about it. But if you talk to global investors, they keep getting fixated on things like the debt ceiling and the shutdown and all these things that we might brush off domestically.
That's a question, though, is if that money comes out, if they're pulling that money out, where they put it? What's more attractive?
Well, I think it's a good question, and I'm not sure what the alternatives are right now. I mean, one of the things I've been writing about in my weekly is that if you look at the EPFR fund flow data, we're just starting to see outflows from everything, including money market funds. So it is a little bit of a question as to where that money is going to at this point.
So for your year-end target for the S&P 500, you're sticking with 4250, which basically is kind of where we are right now. Yeah. What's the path to getting there? Is it going to be some big wild swings and then we end up there, or is it just going to be, stuck in this tight trading range until we get there?
I feel like we're going to chop around. I don't necessarily sit here and think we're going to have a big gap down and then rally at year end. It certainly could play out that way. I don't necessarily know if I have a lot of conviction about the particular path, but I think targets are funny things, right? I mean, we're all supposed to guess as a strategist exactly where is the index going to be on December 31st. So it's about that, but it's also about the message you're trying to send. And I think the message we're trying to send right now is we feel pretty neutral. The downside risks have grown. There are still some upside risks out there. We don't feel like we belong in the big bad bear camp, and we also don't feel like we belong in that, kind of big bullish camp where people are kind of pounding the table on a year-end rally. We think we've still got some problems to work through.
What's the major sort of upside catalyst that would sort of break us out of that? Is it the Fed? Is it rates? Is it geopolitics tamping down? What?
So, I think any of those things could be catalysts. I would tell you my valuation work, even with 10-year yields at, kind of 5%, still says we can have, a decent multiple at the end of the year. So among all my modeling, my valuation work tends to be one of the more bullish ones. The other thing I'm watching very closely is the AAII Net Bull Bear Survey. Yeah. And that one, this is funny. So we called for a pause in early August, and it was right on the cusp of saying equities were overbought. It's been flirting with the idea that equities are oversold, but isn't quite there yet. We might get there before the end of the year and have a really nice setup for 2024, but we're just not there yet.
Of all the earnings that are reporting this week, what's the one that you're watching for that could really set the tone?
You know, I don't know if there's any one in particular. I mean, definitely I watch the tech companies. I'm also, you know, it's a little early for consumer earnings right now, but I'm watching those. I mean, frankly, I'm just glad that we're starting to get out of financial earnings. Those are not my favorite. But I will tell you the themes I'm watching for: pricing, consumer resilience, and, you know, just the cadence of demand. I haven't been hearing a lot about that yet.
All right, Lori, always wonderful to talk to you. Lori Calvasina there over at RBC Capital Markets here in studio, helping us count you down to the closing bell. Our full market coverage starts right now as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine, Bostick alongside Scarlet. We're counting you down to the closing bell. And here to take us beyond the bell. It's a global simulcast with Carol Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms. Another herky-jerky day here in markets, Carol Masser. But the net effect of it all is most of the major indices right now are in the red. And this looks like we're continuing a downtrend that has really unfolded over the last couple of months here.
So what do we have? 40% of the market cap reporting this week. Can they turn it around, including some big mega cap tech names? We'll see whether or not this trading trend continues in terms of equities. However, one group that's really outperforming anything it seems to do with leisure, travel, hospitality. I'm looking at the S&P Super Composite Restaurants and Leisure Index up 2.6%. Super Composite Hotel Index up about 1.6%. I'll tell you a little bit why Carnival's on the move in a moment, but nonetheless, Scarlett, that world is on a tear.
I'm looking at the intraday chart of the S&P 500. It's just slow rise up and the slow descent. Is this what it looks like when there's no Fed speak?
Well, I don't know. I woke,
That's a good
logging
point.
in this morning and keeping an eye on the markets, Scarlett. We saw a decline of up to more than 0.7% on the S&P 500. Then just moved higher for most of the day, and now it's declining. I kind of thought today was going to be a fourth down day in a row.
Well, it's funny.
Well, it will be, I guess,
well,
but not significantly.
Yeah, well, I mean, but we are moving lower here. Interesting, though, too, I mean, on that point, the column that we had by Mohammed El-Arian on the Bloomberg earlier today really got into that idea of just how much Fed speak is sort of causing volatility. And he kind of pointed out just in the last appearance by Jay Powell at the Economic Club, just how much Treasuries moved off the back of those comments. And it really raises the question here as to whether the commentary, the public commentary, is as useful as maybe the Fed thinks it should be. All right, we are getting the closing bells here in New York. Let's round out the day with the Dow Jones Industrial Average down almost 200 points, or roughly 0.6% here on the day. The NASDAQ Composite is going to hold in the green, up by about 34 points, or about 0.3%. And you could thank most of the Magnificent Seven for keeping that afloat. But take a look at the S&P 500. A trade today below 4,200, a close above 4,200, but still down 0.2% on the day. A fifth straight day of declines. That's the longest daily losing streak for the S&P 500 in 2023. The Russell 2000 also lower on the day. Carol, down by 0.9%.
All right, and a quick check on the S&P 500. Romaine, if I dig a little bit deeper, you're talking about most names in the index, 375 to be exact, to the downside, 137 higher, one unchanged. But, you mentioned volatility, and Scarlett, if you look at the VIX, it's actually down about a point in today's session, which how do you get your head around that considering the trade that we saw today?
Yeah, well, I mean, the moves were not, actually they were for the S&P 500, but the VIX has not been the greatest signaling tool for a while now. Let's take a look at the sector performances. 7 out of 24 groups finishing in the green, and as Romaine mentioned, Magnificent Seven, and you can see that with chip makers, media, entertainment, software services leading to the upside. On the downside, you've got transportation stocks, energy, and banks all down by at least 1.5%.
All right, let's get to some of the individual gainers in the S&P 500 and the NASDAQ 100. Top in both of those is Walgreens Boots Alliance. That stock up as much as 6% at its highs today, finishing the day with about a 3.3% gain. JP Morgan coming out, raising the company's rating to overweight from neutral. The analysts there saying there is clearly work to be done. Talks, though, about this healthcare-focused management team, a refreshed healthcare-focused management team, and a lowered but credible bar. She really puts a lot of focus on the new CEO, Tim Wentworth, bringing what he brings to the company, especially his expertise, his knowledge in the healthcare space. So definitely singling that one out. Do you want to mention Carnival? I talked about hospitality and leisure, really on a tear today. This was a top name in the S&P 500 earlier today. One of the company's corporate directors, Randall Weissenberger, reported an insider stock transaction to the S&P, so buying about $1.15 million worth of shares. Stock's down about 19% in the past month, so maybe he saw a little bit of a bargain there. It is up about 43% year to date. Airbnb, again, that hospitality leisure outperformance today. This was top in the S&P and NASDAQ 100. Investors warming again, I guess, to the sector. It's interesting to see this, but you saw Airbnb. I'm just going to take a look at it, up about 3.3% in today's trade. And I do want to mention NVIDIA was also top in both the S&P, planning to make some ARM-based PC chips for Windows. That was a Reuters headline earlier today. Just thought I'd mention.
All right, NVIDIA's gain, Intel's loss, which I'll get to in just a second. Let's start, though, with Chevron. Shares finishing the day down by more than 3.6%. Let's round that up to 3.7. Worth taking a look after the announcement that the company's going to buy Hess for $53 billion. We know the details. We've been talking about them all day. $171 per share for Hess. It's a premium to about 10% of the 20-day moving average price. The acquisition will give Chevron a significant foothold in Guyana. That's the South American country that borders Venezuela, Brazil, and Suriname that have found oil over the last 10 years. Let's look at shares of Intel. Carol mentioned this, but just in the last hour, Reuters reported that NVIDIA is using ARM Holdings tech to develop chips that would challenge Intel processors in personal computers. Shares of Intel falling just after that report, which Bloomberg ended up matching. Shares of Intel falling by 3% today. We should note that it ratchets up competition between the two semiconductor makers and continues that fight between them. And then FMC, the worst performer in the S&P 500 on a percentage basis today. It fell by as much as 26% earlier today. It was the biggest intraday drop since 2020. The company's slashing its adjusted earnings per share guidance for the third quarter. In the wake of that, Wells Fargo cut its price target amid weaker trends in Latin America destocking. We also saw peers of FMC, it's the agricultural chemical company, fall. Shares of Corteva, Nutrien, Mosaic Company, CF Industries, all falling today as well.
Yeah, this is a big story, and I'm surprised. I mean, I know it's kind of a more obscure company, but you talk about the importance of the global economy here, and the idea here that when these fertilizer makers are hit, remember, this is more a climate change issue that they're dealing with right now, so these could be longer-term structural issues that could affect investors going forward. Let's check in on what happened in the Treasury market, and of course, everyone knows Scarlet was up at about 5 a.m. this morning, sometime around 5:40 a.m. New York time. We saw that 10-year yield scrape past the 5% mark for the first time going back to 07. As you can see on your screen, though, that did not last. We're actually down almost 15 basis points from where it was earlier in the session and down 6 basis points from where we started the day. So interesting moves to see that whether that 5% was kind of the line in the sand to bring buyers back into this market. You also saw most of the rest of the curve also shift a little lower here on the day with about 7 basis points lower on that 30-year yield. I am curious, though, guys, there's been a lot of speculation as to sort of what caused this swing, both the jump higher and then, of course, the bump lower. And a lot of people are pointing to a lot of things, but they're also pointing to the tweet or the whatever you call it, the social media post by Bill Ackman saying that basically he's throwing in the towel on the short and saying that he's concerned about geopolitical risk and that it's just not a safe time. And then Bill Gross coming out and kind of saying something similar that, you know, there's an embrace of safety right now. And I wonder how much that fed into sentiment.
Yeah, it's a nice round number that gets people's attention, and it's as good a reason or a time as any to come in here and say, you know what, maybe I'll come in. One thing, of course, that it's had is the impact on equities. This marks the first Monday that the S&P 500 has not gained in 16 straight weeks. So we've snapped the 15 straight Monday gains for the S&P 500, which was always a little bit curious. It was a weird phenomenon 2023.
Yeah, that's an interesting trend break, if you will. Gina Martin-Adams was on earlier from Bloomberg Intelligence. She said a third of the S&P 500 companies are above their 200-day moving average. A 200-day moving average, excuse me. She says you look for 50% to be above that mark if you want a sustainable uptrend. So I have to say, I feel like all of the market conversations we had today, Gina, we also had Anne Maletti on, I feel like they were very subdued, if you will, in terms of the equity market and the concerns, you know, that are facing maybe a lot of companies out there.
Yeah, Anne Maletti, you know, sort of argued with us that even though we're, you know, not in a recession defined by the data right now, and we're still seeing job gains each and every month, that in a lot of parts of the country, and she's based in the Midwest, she would argue that, you know, a lot of people do feel like they're in recession with car payments above $1,000 a month, people, housing affordability out of reach, food prices going up, Romaine.
It's called the real economy.
It is called the real economy.
And I don't say that to be glib. I mean, it's for some
great
reason.
gut check, right?
But it's hard to reconcile that with the numbers that we get every month.
Yeah. Well, we asked her about, so what do you make of the retail numbers? She goes, I don't get it. I really don't get it, because you've seen even the high-end luxury that are supposed to be, you know, sustainable no matter what, and even you see some, you know, problems there. So it's confusing, I think, to say the least.
It just puts the pressure on companies to really wow investors one way or another if they want to generate some kind of big reaction in the stock, because just delivering on a beat is probably not going to do it. Given what BI has found out, Bloomberg Intelligence has some data showing that investors are not exactly rewarding companies that have narrow beats, at least so far.
So what does Microsoft do tomorrow, right? Like, you think about some of the big ones. Does that kind of, I don't know, change the tone, the trend? I don't know. And we are in this vacuum where we don't have the Fed speak.
Why would it? But I mean, that's the problem. I mean, if it's just going to be Microsoft and Nvidia and Apple, Amazon, and Meta, that's not a market. I'm sorry, it's not. That's a basket of stocks.
Right, but it has definitely shaped the overall market trends often, right? And even though we talk about it being so concentrated in the handful of a few big names, it doesn't necessarily, it does swing the momentum.
Well, talk to me when they're buying oil and gas companies and fertilizer companies and tractor companies and things like that. I'm not knocking you. I'm just saying.
No, I don't disagree, right? But we say it over and over again. Then we see that trend of like investors just moving into some of those names that aren't representative of the broader market, if you will. All right, I guess we have to wrap. All right, guys, that's it for the cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals. We will see you again, same time, same place tomorrow.
All right, coming up here, a closer look at what's been going on in the broader markets, a closer look at some of the big earnings this week. David Neuhauser, founder and CIO over at Livermore Partners, going to be joining us to give us his outlook. That conversation coming up next on The Close. This is Bloomberg. Another choppy day on Wall Street, driven, of course, by the volatility that we saw once again in the yield space. Your 10-year yield scraping above the 5% mark early in the session. First time we've seen a trade at that level going back to 2007. Of course, you did see a pretty precipitous drop come pretty quickly after that here. In fact, you look at the top of the screen, 484. That's 15 basis points more than 16 basis points lower than where we were earlier in the session. The back and forth, of course, has caused a lot of agita amongst investors, and that included the S&P 500. Which flipped from red to green and then back to red again, down 0.2% here on the day, down back at that 200-day moving average, and a trade at one point on the day below 4,200, that nice round fat number that a lot of people say is going to be retested time and time again. The Magnificent Seven trying to do their best to keep this market afloat. All 7 of those names did move higher on the day, about 1% gain for the group as a basket. Of course, we get 3 of those names reporting earnings a little bit later this week. The Philadelphia Semiconductor Index lower on the day, and the XOP lower as well, as oil and gas stocks started to move lower. You did have a pretty good day for Bitcoin. Remember Bitcoin? We don't talk about it much here, but a push above 31,000. First time we've seen that in quite some time, and more speculation continuing that drumbeat here about final approval of some sort of an ETF, and the net asset value, that gap that we've been seeing between market prices and that net asset value discount continues to narrow here on one of the main names that we take a look at, the Galaxy Bitcoin index here. You can see right now sitting, Scarlet, at negative 11.
Something we'll keep an eye on, of course, as we monitor all the market moves. And, of course, another thing we're monitoring are all the deals in the energy space. Another mega deal, in fact, because Chevron will buy Hess for roughly $53 billion. Both CEOs spoke about the merger earlier today on Bloomberg.
Our stock for the last 5 years was the #1 total shareholder return in the industry, whether it's independent or whether it's major oil company. Last year, our stock went up 94%, #2 on the S&P. So we've already created a lot of value. At the same time, now that the pricing got in a range that would work both for Chevron and work for Hess, we think we came up with a win-win. Hess brings Chevron growth in resource, growth in production, growth in cash flow. Chevron brings Hess financial strength in terms of a diversity of world-class assets, in terms of sterling balance sheet, and in terms of industry-leading cash returns. And when you put the two together, you create the premier oil and gas company positioned for the energy transition.
Mike, what I'm hearing here is that this is a great fit. Could you do this on your own? Could you build what Hess has built from the ground up? Is it easier to buy than build right now?
Well, look, this is about long-term growth and long-term value, which is what we're always seeking. Hess has a unique portfolio that actually strengthens our portfolio with some things we're always trying to do. We're always out exploring. We're looking for new finds. Guyana's the biggest discovery in more than a decade in this industry. It's just a unique and compelling asset. And so it would be difficult for us to do on our own. We continue to explore. We'll continue. Everybody in our industry is looking for these things. But this was a great opportunity for us to join a partnership that's done a terrific job in developing this asset. But also the other assets in the Hess portfolio are ones that will be additive for us as well, the Bakken, the Deepwater Gulf of Mexico, Southeast Asia. And so it's a very nice fit at a portfolio level, nice fit at a culture level, and we're going to create more value for shareholders.
Meanwhile, our next guest says there's lots of upside to buying small oil caps, or oil small caps. There we go. Here in studio to tell us why is David Neuhauser. He's founder and CIO of Livermore Partners, usually in Illinois, but here in New York today. Great to see you, David.
Hey, great to be here again.
So your portfolio company, Calibri Global, just listed on the NASDAQ. I know you were there to ring the bell. It's an E&P with a small market cap, $163 million, tiny. But in general, you do like small oil small caps. To what extent is M&A part of the appeal, part of the picture there?
Well, I think it's growing today, Scarlet. So like in the past, like Livermore, we would be looking at some of these small companies as just like deep value, opportunistic type scenarios, things that you and I have discussed in the past. I think today the dynamic is shifting where it's becoming much more of a value play, but also there's this takeout potential that you're going to see further consolidation. You know, as you point out here this morning with the Hess deal, you saw the ExxonMobil deal, you know, the biggers trying to get even bigger. But eventually you're going to see some of those mid-cap companies as well that they're going to look around, they're producing, and they're going to say, how do we get bigger? How do we get more reserves? So one of the things, the dynamic even with Calibri that's so interesting is that it's a company with a small market cap, but actually has a big PUD reserve, like big proven undeveloped reserves. That so in actuality, the company's worth closer to $1 billion on the reserve basis. But today you're just getting the value based on their cash flow and what's called PDP. So I think you're going to see many more deals like this, and it's going to start to flow downstream to the smaller end. So from my standpoint, from like Livermore, you have a hedge fund, you're looking at making outsized returns. So you want to own those things that are really undervalued and yet have this sort of real potential to create a lot of upside on a takeout. Whereas some of the larger groups that you're seeing today, yeah, they're getting taken out at a premium, but they're relatively small premiums because they're such big companies, and they're only benefiting from the synergies at play.
So it's curious that there's so much deal making when interest rates are high and the environment may not necessarily be great for a lot of M&A. So at what point will these higher for longer rates start to put a dent on the excitement over making acquisitions?
You know, I think the cost of capital would still have to go even higher for that to put a dent on it. In fact, I think the higher cost of capital the cause and effect is you'll see more deals because of the higher cost, because there's still a lot of smaller, they rely on borrowing. There's still not a lot of available of capital out there in the energy market over the past several years, as you guys know, and therefore you haven't seen the investment required in the sector. So, you know, it was obviously hated for several years, and now, you know, given tension in the Middle East and giving other issues at play, people are starting to understand the dynamics behind oil and gas. This is something that's required, that we need investment. We have it here in the United States as well, and we can learn so much and gain so much of these reserves. So you have to see investment. And that's why some of these smaller companies that don't have the balance sheet are going to ultimately be relied on to see merger partners at some point in time.
I'm curious here. I do want to pivot, David, to some other industries here. And the areas of concern seem to have been around banks and financials, obviously the regional banks and the big crisis earlier this year. But the big banks overall have held their own, though they may not necessarily be the growth story that some people were hoping for.
No, well, they're not the growth story because still a lot of those big banks, they still have big balance sheets and a lot of held to maturity assets.
Yeah.
So they have these unrealized losses on their books that they don't have to realize today because they have these huge deposit bases, right? But at the same time, if you would mark to market these unrealized losses on a lot of these companies, you know, Bank of America, Schwab is another one. These companies wouldn't have any book value, so they're essentially, you know, get wiped out as an equity holder. So the idea today, of course, is there are these huge money center banks, and they rely on deposits that are very sticky, so they don't have to do anything today. But it's always easy to say that when there's liquidity. When there's no liquidity and people are looking for capital and looking to pull their deposits, that's another story. So to think that what happened in March can't happen again, I think that would be somebody that's miscalculating the future.
And there's a lot of folks who think that what happened back then still hasn't completely played out, particularly given that rates have stayed where they are here. When you talk about the path of treasury yields, obviously a lot of people are looking at the supply coming down the pipeline. They're looking at the dysfunction in Washington and the fiscal issues that might actually exacerbate that supply. How do you position yourself? And I'm not really talking about in the short term, in the here and now, but much more longer term, if this is our new normal.
I think the one word to say is that we're in a world of risk, and the word I was going to use would be scared, because you have so much uncertainty as we look forward now in terms of the market environment, in terms of the world environment. It's going to be very difficult to determine, even from a government standpoint, like, how are we going to get our fiscal house in order in the United States? A lot of people are looking to 2024 saying, oh, it's an election year, markets go up, right? You tell me how that election's going to look. You know, going into that election, it's going to be completely dysfunctional. And I think whoever wins, the issue is, how are they going to attack the fiscal deficits, the budget deficits, the trade deficits? We have to get our house in order here in the United States, also in terms of other areas of the globe. And the issue is, as you touched on, the treasuries hitting 5%. I mean, I think the treasuries could go much harder, because in reality, what you're seeing playing out from, you know, has been happening in like 10, 20, 30 years, which is these bond vigilantes coming at play. And to me, they're dictating the market. It's technically not the Federal Reserve anymore. And until people really understand that, I think
and even the Fed has kind of tipped its hat to that, saying that some of their work was actually done by the bond market.
Yeah, exactly. And I think the difference is, you know, the Fed has a job to do, and our government has a job to do, and the Fed can only do so much. The issue is, of course, we're running at these huge deficits, like 120% of GDP, and you're going to have to see massive spending cuts as well. So it's a very tricky environment, is what I'm trying to say.
All right, David, this was a great conversation. I wish we had more time. David Neuhauser, they are founder and CIO over at Livermore Partners. Stick with us here. A big week for some of the magnificent 7 tech companies, which are set to report their quarterly earnings through the week. We're going to preview what to expect. This is Bloomberg. The latter half of the year has been a particularly busy period for mergers and acquisitions. More than $139 billion in takeovers of publicly traded U.S. companies have been announced this month alone, the highest volume for any month going back to June 2019. Matthew Monk's joining us right now to talk a little bit more about this. Obviously, $50 billion from Chevron, $60 billion from Exxon, and a couple other big deals over the last couple of months here. But what's volume actually looking about, the number of deals getting done?
Yeah, so we are still down year to date on number and deal transaction values. So even though we're at around $2 trillion for the year, that's still down 30% year over year. If you take these 2 big deals out just this month, we're on track for about $40 billion. So, you know, minus those 2 deals, it's still kind of a normal deal, at least in terms of deal value and deal values, but still big deals are what it's all about. They build confidence in the marketplace, and we like to say that deals beget deals. So these are definitely, positive green shoots that we're seeing. Is it good enough to say, oh my goodness, the M&A drought is over? I wouldn't quite say so.
Yeah.
But we're moving in the right direction. And as it comes to energy M&A, I think there is actually something going on there.
How quickly are these deals coming together? I mean, are these things that you guys, when you're reporting, you hear that there's, details of it coming out, you're just not sure who, and it takes a while for it to emerge, or are they happening fairly quickly?
There's two ways to look at it. There are no original deals in the M&A landscape. These things have been thought about for years. If you saw your great coverage today with Chevron and Hess, they talked about how this, they were talking to each other for several years. This deal in particular could have happened 5 years ago, 10 years ago. There's just no really, new ideas out there. So these are old ideas, but that said, when they come together, they often come together fast.
Mm-hmm.
We picked up chatter that there was like 2 big energy deals out there, like probably about 2 weeks ago. So I would say the long way to answer that, these are old ideas that are kicking around, and then all of a sudden they just happen overnight.
This gets to the broader question, though, as to how much of the market is actually dependent on this, right? So we talk about, you say these deals sort of instill, big deals,
That's right.
instill a bit of confidence here. No one expects what we've seen over the last couple of weeks with $60 billion on Pioneer and this one on Chevron to be the new norm, at least not in the short term here.
I don't see how it can be.
But what about, well, why not? Because here's my question here. If they have the stock price to fund this, or in other cases where they have the cash to fund this, why not? If you don't think the regulatory risk is there, the antitrust risk is there, why not now?
Because these are huge, risky transactions.
Yeah.
If you go back and look at Exxon's last gigantic deal of XTO, it was, I'm not going to say it was a bloodbath. It was a $40 billion deal. They ended up having to write it down by 50% or whatever it was. These are very risky transactions. The things with companies like Chevron and Exxon, they think in very long-term horizons. They're very financially sound. Oil prices are in the right direction. It feels like interest rates are in the right direction, so they feel confident enough to kind of make a huge bet. But I don't want to overstate that these are very risky transactions.
Yeah.
And if I were running a large oil and gas company right now, I would maybe sit back and be like, well, let's see how this shakes out. Let's see if it gets through the antitrust risk, and let's see how it's received by the street.
All right. Well, Matha, you are actually smart enough to run a major oil company,
Yeah,
if you will.
right.
But for right now, he works for us here at Bloomberg News. Stick with us. A conversation coming up in a second with Henrietta Treyz. The S&P 500 closing lower here on this Monday afternoon. It was the 5th straight session where we've seen the S&P in the red. That hasn't happened all year long. The longest daily losing streak going back to at least December of last year. But more importantly, a lot of those key technical levels, the 200-day moving average breach. And at one point on an intraday basis, we had the S&P trade below that 4,200 level here, that nice round number that a lot of people see as a potential harbinger should it actually stay below that level. A big part of the volatility that we saw in equities was because of the volatility that we saw in the Treasury space. A run up to 5% on the 10-year yield early in the session, though that came undone pretty quickly here, and you did see a lot of buyers come back into the Treasury space, not only in the belly of the curve, but also on the long end and the short end. So that actually pushed the curve lower here on the day, though still elevated by a significant amount overall. A similar narrative here for the VIX, which actually saw a 1-point drop here on the day. But remember, at 20, that's still very elevated from what we've seen over the past few months here. WTI crude also pulling back here on this day. Scarlet, remember the big run up that we had seen over the last couple of weeks because of the situation in Israel and Gaza. That's being unwound just a little bit, but still some trepidation holding at $86 a barrel.
All right, and of course, we'll continue to monitor that as we are monitoring events in the Middle East as well, because this week, dozens of titans in global finance will be heading to Riyadh for the Future Investment Initiative. It's called Davos in the Desert by a lot of people. But of course, conflict in the Gaza Strip remains top of mind. This as Saudi Arabia pushes for a new economic era in the region. For more on the latest in the Middle East, we bring in Bloomberg Balance of Power co-host Anne-Marie Horder in D.C. And of course, as Riyadh gets ready to host this conference, we are keeping an eye on the developments on the ground in the Middle East. And Anne-Marie, the latest headline that Hamas has freed 2 women in hostages as part of the hostage release. What do we know about whether Washington played a role in that?
Well, Washington has been in constant communication with their counterparts in Israel really the main brokers of all of these hostage releases, which we had 2 over the weekend. And then, of course, these 2 elderly women that were released today. They were taken alongside their husbands, but their husbands were not released. But these 2 elderly women were put into the hands of the Red Cross. A lot of the dialogue has been conducted through Doha, through the Qataris, talking to Hamas and working on the release of these individuals. The president, though, was asked today about a ceasefire. You know, he is pushed by many members of the progressive wing of his party to call for a ceasefire. He says, release those hostages and then we can talk. So this is what is going on right now. This is how incredibly horrific and tense these moments are right now between Israel and between Hamas and, of course, the Palestinian civilians in the Gaza Strip. Yeah. At the same time, you're going to have really the titans of banking and global finance heading to Riyadh, which would have been really talking about the future of the Middle East, which in the past, Mohammed bin Salman talked about a renaissance. He called it the new Europe, and really wanted to focus on the economics of the Middle East. And now what you're seeing is old, really, fractures in the region coming to light.
Well, that's what I'm curious about here, Anne-Marie. Sort of, I mean, the narrative right now is this has sort of scuttled the potential normalizations of relations between the Saudis and Israel. But they've also been relatively quiet over the last few days, and maybe for good reason. And I am curious as to what we know about some of the back channels of diplomacy. You mentioned the role of Qatar, which seems to relish having this sort of a neutral role of being able to broker deals. Have the Saudis actually poked their head up at all on this?
Well, there's tons of back channels when it comes to Riyadh and the United States. We saw over the weekend as well, Mohammed bin Salman, for the first time in 3 years, we saw him in public with Mohammed bin Zayed of the United Arab Emirates. These are 2 huge players in the region. What I would say on normalization is that everyone is talking about this quote-unquote pause to normalization. Are there as many meetings happening right now between normalization? No, of course not. The United States is supporting Israel, and Israel at the moment is focused squarely on getting hostages back and also what they call eradicating Hamas. But is normalization still, for Mohammed bin Salman, a priority, likely, for where he wants to take his country as well for the Israelis? Yes. So maybe it's hitting a little bit of a pause or a break given this current crisis and conflict, but I wouldn't say it's over.
Anne-Marie Horder, and you can catch her as co-host of Balance of Power, which airs at 5 p.m. Washington time. Meanwhile, we continue the conversation right here on The Close with Henrietta Treyz, Veda Partners Director of Economic Policy. And Henrietta, I want to start off here with this idea of kind of what comes next in terms of policy, right? We have this idea of everyone sort of on edge, waiting to see what the Israeli response is going to be, meaning if there's going to be some meaningful ground incursion into Gaza. There's a lot of money sitting on the table here in the U.S. that has to be approved. There's obviously a lot of questions about some of the Middle Eastern neighbors, allies, partners, if you will, and what they will do next. What should markets be on guard for right now?
Well, right now, the entire ball is in the executive branch's court. So all military aid is coming via the president. They are reshuffling funds that have either already been allotted towards Israel over the last couple of years or exist in baskets that the president's able to tap into at the Pentagon and the State Department. And that is mostly going to go to munitions. But there is a waiting in the wings package of undetermined size. Right now, it's $106 billion, but it could rapidly grow to at least $120 billion. And I think most of that plus up between what the president's asking for and what Congress wants to deliver will probably be split between Israel and the U.S.-Mexico border. And funding that will go to effectively the defense industrial system, and also a fraction of that to humanitarian aid, about $9.2 billion in humanitarian aid, will immediately be unlocked. What we have in D.C. is obviously inability to move forward, but D.C. is a very slow-moving place in general, and that's by design. So the White House, from the investment perspective, the White House is really going to be in charge of this narrative for almost a full month from now, at least 2 to 3 weeks. There's a hearing that just got set in the Senate Appropriations Committee that should be obscure and sort of a snooze fest, but instead you're going to have the State Department Secretary of the State Department and the Secretary of State both testifying on the need for this $106 billion supplemental. And that's going to start the ball rolling on Halloween, and it'll continue into November.
I'm sure you know that, at least in the court of public opinion here in the U.S., there are a lot of folks who sort of question the U.S. Spending on things like this. They were already questioning our commitment to Ukraine. And now, even before the money has been approved for Israel, they're already questioning that. I am curious, when you look at the economic climate, or excuse me, the political climate here, and the idea that $14 billion for Israel and whatever else is there for the border in Ukraine, that might not actually be the end of this, that we may need to come back more. Do you think there's going to be the political will to do that, particularly in what I'm sure you already know is a pretty fraught environment?
Romaine, you're definitely asking me to answer a hardball question there, because we have to tackle also whether the government's going to shut down. But from my experience, what usually happens is we throw money at the problem. We don't make it cheaper. So as I mentioned before, there's $60 billion in aid to Ukraine. Maybe that comes down a little bit, but the $14.6 billion he's requested for Israel is more likely to rise than decline. The aid to the U.S.-Mexico border similarly is more likely to rise than decline. And I think what happens is you don't see these bills get smaller, particularly now that we're waiting on the U.S. Senate to act, because the House is in such a state of disarray. The Senate is going to come in. You have sort of the old establishment bulls in the appropriations committees who are leading this charge, and they're the ones that are going to come up with, I think, a very big package, and it might be the last bill we see all year.
Okay, so the Senate drives everything, and the House, if they can get their act together at some point, will not rubber stamp it, but just pass what's already been done up by the Senate. What's the most effective argument the White House can make, that President Biden can make, not just to lawmakers, not just to the Senate and to members of Congress, but also to the public, on why $106 billion is a worthy investment in Ukraine, in Israel?
Well, they're definitely making the argument about NATO and the import of NATO, linking these two wars and atrocities together as they work to sort of secure hostage releases. That's an extra added advantage. But I would encourage people to look at it maybe from the other perspective. If you want to have oversight over this funding, if you want to have any conversation about Iran and maybe harken back to that $6 billion, that $1 billion that was unfrozen a couple months back and has since been refrozen. If there are any Republicans out there who want to have any word in this, they need to pass a bill. They need to reopen and get this legislation on the floor. And it actually serves as a boon to the administration, because they're going to be fighting to prove that they're more pro-Israel. They're more pro supporting that cause. They're more pro-investigating how we got here in the first place. But in order to do that, you have to actually pass legislation. So I think this should be a path that a seasoned legislator like Biden, like Schumer, like McConnell can pretty easily glide the conference towards supporting and plussing up, as I suggested.
Okay, and very quickly, what's going on in the House of Representatives in terms of how quickly can perhaps Patrick McHenry's role as the Speaker pro tem be made somewhat more solid, and he'll have some more authority beyond, calling for elections of the new Speaker?
This is the kind of time where you really need to have a stiff backbone going into this. It's going to be weeks. I don't expect any kind of resolution. There are 9 people in the running right now. None of them has 217. They're all in fighting. The McHenry solution is the one that I agree is the most likely, the path of least resistance. But by definition, it can only come at the 11th hour. It's only a break glass in case of emergency situation. And so we need to be in an emergency. We're not even going to have this first hearing until Halloween. We don't need the government shutdown bill until November 16th. I think we could be in a speaker's dilemma for the next 3 weeks. And really, there is no urgency, as illustrated by the fact that there are 9 people currently running for the same position, none of whom have 217.
Yeah, and which I'm sure like 8 of them, I don't think any American person out there would even be able to name them. Henrietta, great to talk to you. Henrietta Treyz, Veda Partners, Director of Economic Policy Research, a look at what's going on in Washington, particularly when it comes to funding some of the efforts overseas to protect our national security. Meanwhile, we turn back to earnings. It is a big week for earnings, with about 30% of S&P 500 companies scheduled to report, and that includes some of the big dogs, Meta, Apple, Alphabet, Amazon, just to name a few. Stephen Slowinski going to be joining us to give us his insight after the break. This is Bloomberg.
Tomorrow at this time, we're going to be going through a ton of earnings because we have about $15 trillion of companies reporting earnings throughout this week. And tomorrow, that begins with Alphabet and Microsoft. Simone Foxman has all the details on what we should be looking for. Simone?
Yeah, Scarlet, we actually get 4 of the so-called Magnificent 7 reporting earnings this week. As you mentioned, Alphabet and Microsoft kicking those off, at least the ones coming in this week. And then we get Meta on Wednesday, Amazon on Thursday. There are any number of issues here that we are going to be focusing on, everything from China to consumer sentiment to business spending. But I think if there's one main issue that we're going to be focusing on is AI, and especially costs surrounding AI. We will answer some of those questions when we hear from Microsoft tomorrow. AI is just a very expensive thing to pursue. So can Microsoft keep up the kind of earnings growth it wants to see, even though the costs are high? We'll also hopefully get some answers on this from Alphabet as well. Truist says that Alphabet has really been on the offensive with AI. Will investors like what they hear? Once we hear from them, we'll look to Meta. Is AI helping user engagement? That's going to be a key question there. Is that bringing in more ad revenue? And then finally, with Amazon, does Amazon Web Services hold up? Now, of course, this is really important. They're very high stakes for the equity market, and you can see it here on the GTV Go in front of me. We have watched as bonds, the value falls, the yields rise, and the Magnificent 7 here in the white. They have held up over the last couple of quarters, but really the gain, as opposed to the S&P 500, which we're showing here, really all of that was in the first half of the year, and we've essentially gone sideways for the second half of the year. Now, if we had not seen these dramatic gains in the Magnificent 7, the S&P 500 would only be up about 0.6%. Netflix set the bar very high in terms of tech earnings, but the question mark is, can these companies continue? Bloomberg Intelligence says that companies who are missing their earnings expectations, especially on profits, the most damaged since 4 years in terms of the trading that's going on in the market after those earnings report. So potentially, watch out below if we see anyone disappoint, guys.
Bloomberg, Simone Foxman, a nice wrap up there. Let's continue the conversation right now with Stefan Slowinski, BNP Paribas, global software analyst, to talk a little bit more here about some of the earnings that we're going to get. And Stefan, I want to start off here where Simone started off, which was about AI. And I mean, that was kind of the hot topic, the buzzword, if you will, coming out of those Q1 reports and especially in 2Q. Has that sort of faded? Are we still expecting to hear a lot of talk about AI on these conference calls and reports this week and next?
Yeah, hi, Romaine. First, thanks for having me on. And yeah, of course, AI is going to continue to be a focus. So we really see 2 waves. The first wave that we're seeing right now is the first products coming to market. So those are being embedded within the existing SaaS offerings. So of course, Microsoft 365 Copilot, which goes live on November 1st, is the big one. But we also see Google, Adobe, Salesforce, all of them live with capabilities in the market and importantly starting to monetize them. The second thing, though, that people are starting to worry about is that second wave, which is taking a bit longer. So it's enterprises going to the cloud and developing enterprise AI services. And, you know, that's something that may take a bit more time. And so we're starting to see investors get a bit worried about the timing of the return on investment. You saw Oracle shares quite weak last week on Friday. They're really talking about a bit of a delay between bookings of AI-related demand converting into revenues as it takes time to get those GPUs up and running.
Because there is really kind of a CapEx spend issue here for a lot of those potential customers and users of this stuff. And I know for some of them, they were just kind of dabbling in it, trying to see if it would work and they could turn it into some sort of a business model here. But overall, when you look at the pressure on CapEx at a lot of corporations here, does this become not just a story about AI, but also whether we're going to see some softness in the traditional cloud and software businesses that most of these companies operate around?
I think right now, and we saw the results of our recent BNP Paribas quarterly software reseller channel checks, is that IT demand is pretty stable. So you could say to a certain extent that it's a bit of a zero-sum game. So there is some concern that if some spend gets allocated to AI, it may be taking away from somewhere else. And so we're seeing investors focus a bit more on where there could be risk to 2024 numbers. We saw just in the last couple of weeks some of the Indian IT services companies talking about projects being delayed or pushed out. So investors are trying to understand whether or not we're about to reaccelerate because of AI demand or whether we're about to decelerate because of a weakening macro environment.
Can the different software companies comfortably fund all these AI initiatives, pushing them out? Or is this going to involve decisions where perhaps there are fewer buybacks or perhaps they might need to issue some debt?
Yeah, I mean, when you look at the companies really driving that CapEx, it is the big hyperscalers who, of course, have pretty massive cash flows from their core businesses. So it's not necessarily a question of having the cash to be able to finance it. But obviously, it's denting returns near term. Yeah. A good example is Microsoft. They're not yet seeing the benefit of AI in terms of the revenues or profits coming through, although we expect that to start relatively soon with Copilot going live. But they are, as you mentioned before, seeing CapEx jump probably at least 40% this year. So it is pressuring free cash flow. Because of that, some investors are looking at valuations and saying, you know, Microsoft's currently trading on just a 2.5%, maybe 3% free cash flow yield, which starts to look a bit expensive relative to some other options now in the market with rates where they are.
So when it comes to the earnings reports that we're going to get this week, which company is going to set the tone for growth in the cloud business? Is it Microsoft? Is it Alphabet? Is it Amazon?
Yeah, it's really Microsoft and Amazon that are the real focus. I think investors feel to a certain extent that Microsoft and Amazon have been de-risked, believe it or not. Both stocks have pulled back around 10% from their highs. We've had some weak data points over the last few weeks from third-party data providers as it relates to cloud consumption. We also had Datadog and Oracle, as I mentioned, make some cautious comments. So expectations have actually come down a bit. So I think investors think that maybe it's been de-risked. Also, when you look at all three of the hyperscalers that we cover, Amazon, Microsoft, Alphabet, they all actually have easing comps because last year some of their consumer businesses were a bit weak. And so actually, when you look at those big three, they actually should see revenue growth accelerating here as we go into Q4, just based on those softer comps. So investors still, I think, feel pretty comfortable with those hyperscalers. They're a bit more cautious towards some of the more traditional enterprise software and IT services vendors.
Mm-hmm. I am curious, though, when you look at the performance of the companies, not necessarily the stocks, is that kind of attributable to the broader themes out there, or is this more about the execution of those individual management teams for those companies? And I ask that because, you know, everybody's looking for that alternative. They want to be invested in this space, but they look at a valuation on some of those names we had on the screen, and they say, that's just too rich. Where else can I go to get that same exposure, but at a more reasonable valuation?
Yeah, I think across those companies, I mean, they've been investing in AI for many years. So Amazon would say we've been doing this for 20 years. Obviously, Microsoft is maybe a bit newer to it with their OpenAI relationship, but obviously caught up very quickly. And Alphabet, of course, is a leader in AI. But we think the software sector as a whole really stands to benefit. As I mentioned before, they're all putting this technology into their products today and monetizing it very soon. And also, don't forget, they're one of the biggest beneficiaries because it helps accelerate the software development process. These software coding co-pilots actually make these software companies more efficient. So they benefit top line and bottom line. And just final thing to answer your question on valuation, look, it's still quite reasonable for a lot of these stocks. Alphabet, 13 times EBITDA. So is Amazon, Oracle, SAP, Salesforce, all incorporating Gen AI into their products, trading on between 14 and 16 times EBITDA. And those are 2024 numbers, including stock compensation. Microsoft a bit more pricey at 19 times, but also probably the most exposed.
All right, gonna have to leave it there. Great stuff, Stefan. Great to catch up with you. Stefan Slowinski, BNP Paribas, global software analyst. A nice preview up ahead. Of course, we are going to get Alphabet and a few other names this week here that could potentially move the markets. We're going to set you up for what to watch tomorrow, which includes some of those names. This is Bloomberg. A potentially busy day for markets on Tuesday, and we start overseas with Davos in the desert, Scarlet.
Yeah, the Future Investment Initiative, Dalio, Diamond, Fink, Fraser, Schwartzman. I mean, it's a pretty impressive guest list.
Yeah, a pretty long guest list there. And back here in the U.S., going to get some economic data, PMIs.
Yeah, we're all looking for things in the range of 4950, right along that growth contraction line.
And, of course, a lot of earnings. This is one of the busiest weeks for earnings. We start with names like Barclays, Unicredit overseas, and then GE, GM, Coca-Cola here in the U.S.
And then in the afternoon, earnings, we're going to be covering Alphabet and Microsoft.
Yeah, big coverage here. Stick with us here. We're going to have full coverage of those earnings. Balance of Power is coming up next today, though. This is Bloomberg.